Hello everyone, a very good evening. So, welcome to the final marathon for our RBWM paper. So, I hope the audio and video is fine. And so, the day is finally here. Tomorrow is your exam, and we have already completed in yesterday's session all the four modules, theoretical part, all the concepts we have done. Today we'll be practicing some very important questions. All the questions that we are going to practice today. We'll be doing case study questions, MCQs, numerical questions, same on the same pattern that was asked in the previous year examination where I attempted. So everyone mark your presence here very quickly, like the video, share the video, and I want this session to be interactive. I'll give you a question on the screen, you'll get 10 seconds to answer it, and then we will discuss the answer. Good evening, good evening. So is everyone ready? I want all of you to participate, all of you to answer and keep a track. If there is any topic that you're getting wrong, you can ask me, you can set it aside, you can revise it after the session as well. Okay? So let us start. We'll be starting with the questions from module B because it is the most important module. All right, question number 1. Good evening. Voice is breaking. Question number the audio is fine from my side. Please check your internet connection. Okay. Is it fine now? Is the audio fine now? Are others also facing this issue? Please give me a confirmation. Is the audio okay? I'm audible? Fine? All right. Okay, so here's the first question for today. The first question. Consider the following statements regarding the regulatory framework for credit card business in India. Banks must obtain prior RBI approval before entering into a tie-up arrangement with another bank for issuing credit cards. A bank with a net worth of rupees 90 crore can undertake credit card business if it does so through a subsidiary. Setting up a subsidiary for credit card business requires prior approval from RBI. And statement 4 says banks can undertake credit card business departmentally without prior approval of RBI. So, which of these statements are correct? Options are option A 1 and 2, option B 3 and 4, option C 2 and 3, or option D 1, 3 and 4. What will be the correct answer? Everyone, start answering. Start answering. Which of these statements will be correct? Okay, so we have studied about the credit card business in our module B. We studied about it yesterday also we had revised. So to start the credit card business by the banks, yes, the correct answer will be option C, 2 and 3 only. 2 and 3 only. See, when we are talking about the prior approval of RBI is not necessary for banks undertaking the credit card business, either departmentally or in the tie-up arrangement. So, wait a second. The question asks about the correct statements, right? First statement will be incorrect because prior approval of RBI is not required. Second statement will be incorrect. The correct answer will be option D. 1, 3, and 4. 1, 3, and 4 will be correct. Banks should have a net worth of rupees 100 crore. Only then they can undertake the credit card business. Okay, departmentally they do not require RBI's permission, but if they are providing undertaking the credit card business through a subsidiary, then it requires prior approval of RBI. So yes, the correct answer will be option D. 1, 3, and 4. Second statement is incorrect. Net worth should be 100 crore. 100 crore, right? Let us move on to the second question. With reference to the credit card transaction cycles, consider the following statements. A credit card transaction involves more parties than a cash transaction. The acquiring bank is the one that issues credit card to the customer. The issuing bank is the party that bears the credit risk until the customer repays. The clearing network facilitates the flow of transaction data and settlement. So, when we are talking about the parties involved in a credit card transaction, recall how many parties are involved in the credit card transaction. So, there are five parties involved. The number of parties increase. The concept is buy now, pay later. Okay, so there's the customer, the retailer, acquiring bank, clearing network, and the issuing bank, right? Issuing bank is the bank which has given credit to the customer. And one of the four parties, excluding the cardholder, has to be out of funds till the cardholder makes payment. So the credit risk falls. Yes, the correct answer will be option A. 1, 3, and 4. 1, 3, and 4. It is the issuing bank that issues the credit card to the customer. Acquiring bank has the responsibility to provide the services to the merchant, right? Yes, it is the issuing bank which has given credit to the customer. So 1, 3, and 4 is correct. The customer makes a purchase from the retailer. In the case of a cash transaction, they pay directly. But in the case of a credit card transaction, there are five parties, so the time taken to complete the transaction will be more. So the correct answer will be option A, 1, 3, and 4. Question number 3. Consider the following statements about the evolution of credit cards. About the evolution of credit cards. The first bank card, Charge It, was issued in 1946 and involved a closed loop transaction. Franklin National Bank launched the first modern credit card in 1951, usable by all customers regardless of banking relationship. Diners Club card, launched in 1950, was technically a charge card requiring full payment monthly. The first plastic card was introduced by the Diners Club card in 1951. Which of these statements are correct? 1 and 2 only, 2 and 4 only, 3 and 4 only, or option D? 1 and 3 only. 1 and 3 only. What will be the correct answer, everyone, about the evolution of credit cards? So in 1951, Franklin National Bank issued the first modern credit card. Before that, in 1950, the first travel and entertainment card was issued by the Diners Club. In 1966, we had the ICA. In the same year, we also had the Bank America Service Corporation. So the correct answer will be the first statement is correct and the third statement is also correct. First bank card was issued in 1946. It was a closed loop transaction. If we are talking about a bank card, right? John Biggins, banker named John Biggins, and it was called a charge it card. Okay. However, the second statement is wrong. Why? Because only those customers who had a bank account with the bank, they were allowed to avail the credit card. Okay, it was available only to the customers. That is why the second statement is incorrect. Third statement is true. Diners Club card launched the first travel and entertainment card, right? The first plastic card wasn't introduced by Diners Club. It was by the Franklin National Bank, the modern credit card. Okay. The first travel and entertainment card was Diners Club. Diners Club. Right? That is why 1 and 3, option D will be correct. And the first card, it was a cardboard card, not a plastic card. All right. So remember these minor points. Question is for incorrect statements. No. Okay. Which of these statements are incorrect? All right. So 2 and 4 are correct and 1 and 3 are incorrect. My mistake. Okay. So 2 and 4 are incorrect, 1 and 3 are correct. All right. Hmm. Next question. Regarding open loop and closed loop systems, consider the following statements. You need to select the correct statements. Correct statements about open loop and closed loop system. Visa and MasterCard operate on a closed loop system where the issuer and the acquirer are the same. Diners Club and American Express operate on a closed loop system with direct merchant and cardholder relationships. Open loop systems require interbank cooperation and centralized authorization. Closed loop systems involve more parties than open loop system. What will be the correct answer about the open loop and closed loop system? What will be the correct answer? In a closed loop system, a single firm captures or processes all of the transaction data. The owners contract directly with the cardholders and the merchants. They authorize and settle all the transactions. Everything is done by the owners themselves. This is prevalent in Diners Club and American Express. On the other hand, in the open loop system, Visa and MasterCard, the transaction data is shared with thousands of members. The issuing bank is different from the merchant's bank, and the transaction is processed through a centralized system. Okay, so the acquiring bank, issuing bank will be different. What will be the correct answer then? What will be the correct answer regarding the open loop and closed loop system? Others also please answer. Everyone. So the first statement will be incorrect because Visa and MasterCard operate on open loop system. Second statement is correct. Diners Club and American Express closed loop system. Third statement will also be correct. Right? Interbank cooperation, centralized authorization. But fourth statement will be incorrect. The correct answer will be option C, 2 and 3. And I've also included the theoretical portion here so that you can revise it. You can revise the part if you are not understanding anything, you want to go through it. So in this very PDF, you'll get the explanation along with the correct answer. All right. Okay. Now question number 5. Ravi's credit card statement dated 2nd October shows a total outstanding of 20,000 rupees. He pays only the minimum amount due of 1,000 by the due date. On 5th October, he makes a fresh purchase of rupees 5,000. He does not make any further payments during the cycle. What finance charge implication will apply to Ravi's account? So we have studied about finance charge. It is applicable when the card holder they choose to pay the minimum amount due or they do not make the full payment within the free credit period. Right? The finance charges are applicable on the unpaid balances as well as any subsequent purchases. So what will be the correct answer? Also, we had discussed how do we calculate the minimum amount due. It is a very tricky concept. If you pay the full credit bill within the free credit cycle, then no finance charges are applicable. But in this situation, only the minimum amount due was paid. That is why the interest will be charged on the 19,000, which is the unpaid amount, as well as the 5,000, which is the new purchase. All right. No, minimum amount due includes everything. When minimum amount due is paid, minimum amount due. Okay, right? On 2nd October, the bill was generated, which says 20,000 rupees. But he paid only the minimum amount due, which is 1,000. And then in the new cycle, he made another purchase of 5,000 rupees. Now, when the bill will be generated in the next month on 2nd of November, finance charges will be applicable on the unpaid balances 19,000 plus the new fresh purchases that have been made. Do you remember the minimum amount due concept? Right? Finance charges are applicable in the event of the card member only deposits part of the total payment or the minimum amount due. The balance outstanding will be carried forward to the subsequent statement. Now, this amount will attract finance charge on the entire outstanding, including fresh purchases and other bank charges. All right? 5,000 will fall in the next cycle. Yes, but in the next cycle, the finance charge will be applicable on the whole amount. Do not forget this concept. When we are talking about finance charges, it will be paid if the customer has paid. When the next cycle begins, when the next cycle begins, they will get the credit free period only if they had paid the previous bill in full. But here they paid the minimum amount due only, not the complete bill. So now the remaining amount plus the fresh purchases will be included in the total bill that is generated on the 2nd of November. Okay, that is generated on the 2nd of November, which will be the next cycle. Right? What does the minimum amount due include? Let us recall this once. The minimum amount due, it includes the statement outstanding, all the new debits for the month, previously unpaid balances, and the other charges as well. It will also include any amount by which the cardholder had exceeded the card limit, right? And then we will calculate the finance charges on it. All right? Option B. Option B. The charges will be applicable on the previous amount that was left unpaid, 19,000 rupees, plus the new purchases of 5,000 rupees as well, on the total. On the total. All right? On the total of it. Okay. Now let us answer question number 6. A cardholder statement dated 2nd December shows 8,000 rupees outstanding. The cardholder pays 250 rupees by the due date. The statement includes 1,000 in billed EMI, 500 in fees, and 500 over limit charges. What is the correct minimum amount due for this cycle? What will be the correct minimum amount due? So calculate the minimum amount due. Do you remember the formula for the minimum amount due? The three criteria were there. It will be higher of the three. Either 5% of the statement outstanding, or sum total of all the installments billed, interest, fees, all the charges. And in case of default, it will be 250 rupees. So calculate all the three and then see which one of them is higher. That will be the minimum amount due. Everyone, answer this question. I'm giving you 15 seconds. What will be the correct answer? So first you need to calculate 5% of 8,000 rupees, right? 5% of 8,000 rupees. Second will be add together everything. So 1,000 is paid in EMIs, Then 500 is paid in fees. 500 is also paid in the over limit charges, and 1% of the installment, the principal. So that would be 1%, 80 rupees. This will become 1000, 2000 and 80, 2080. This will be 400 rupees. And the third option is 250. So what will be the minimum amount due? What will be the minimum amount due? Everyone, what will be the minimum amount due? Yes, the minimum amount due will be 2080 rupees because it is higher of the three, right? So you need to calculate if such a question is asked, a case study, 1% of 8,000, 1%. It is the formula that we are using. Sum total of all installments billed, interest, fees, charges, amount that is over limit, and 1% of the principal. All right? Clear? 1% of 8,000 is 80. That is why we took 80. So 2080 rupees is higher. That would be the minimum amount due. Clear, everyone? Okay. Next. Question 7. A customer withdraws 5,000 rupees as a cash advance. The bank charges 3.49% monthly interest and a transaction fee of 2.5%. The customer repays the full amount after 30 days. What is the total cost incurred by the customer? You need to calculate the total cost. If you remember the type of transaction and the charges, like if a cash advance transaction was there, so it attracted 2.5%. Card replacement was rupees 100 or 250, depending on the card. Overdue penalty is 15% of the total amount due. Over limit penalty is 600. Check return or dishonor fee is 500 rupees. Okay. So what will be the total? Everything is given to you. You just need to calculate 3.49% of 5,000 rupees, 2.5% of 5,000 rupees, right? And then you add it. You add it together. So what will be the total cost incurred by the customer? 5,174, 5,300, 5,474, or 5,749. Calculated. It has been given the monthly interest and the transaction fee. So what will be the correct answer? What will be the correct answer? So 3.49% of 5,000 will be 174.50 rupees. 2.5% of 5,000 will be 125 rupees. But here it is also given minimum 300 should be there. So we won't be using 125. We'll be using 300. So total, what will be the total? 5,000 plus 174.50 and 300 because the minimum is there, 300. So what will be the total? 5,474. The correct answer will be option C. Rupees 5,474. Yes, the correct answer will be option C. Okay. The weightage of numericals is very less in your exam. Maximum 10 to 15 marks is asked usually. But if the institute wants to make it a bit different, then they will change the pattern. They might increase. In that case, such very simple questions will be asked. Percentage, simple percentage is calculated. 3.49% of 5,000. Calculate 3.49% of 5,000. You will get this value. Okay? Hmm. Next. Question number 8. Which of the following statements is or are correct regarding the classification and regulatory treatment of prepaid payment instruments in India? How we take 300 as minimum? Because in the question it is given minimum 300. The question says minimum 300 has to be paid. If we calculate 2.5% of 5,000, it is coming out to be 125. But minimum 300 has to be used. That is why we are taking 300. All right? Yes? Clear now? Okay. See, if you're not very comfortable with the numericals, don't worry about it. 80 to 90% of the paper will still be theoretical only. Okay. Which of the following statements is or are correct regarding the classification and regulatory treatment of the PPIs in India? Closed system PPIs are exempt from RBI authorization as they do not qualify as the payment systems. Semi-closed system PPIs can be used for cash withdrawal at contracted merchant locations. Open system PPIs may be issued by both banks and non-banks, subject to RBI approval. All PPIs must have a minimum validity of 1 year from the date of issuance. So if you remember, closed system PPIs can be used at the entity only which has issued the PPI, right? And it does not permit cash withdrawal. It is not classified as payment system requiring RBI approval or authorization. Semi-closed can be used at a group of clearly identified merchant location, right? But they do not permit cash withdrawal irrespective of whether they are issued by banks or non-banks. Open system PPIs can be issued by banks only. They are used at any merchant location for purchasing goods and services and financial services as well. They also facilitate cash withdrawal at ATMs and point of sale terminals. Okay? All PPIs will have a minimum validity of 1 year. They can be reloaded again, right? They have a clear laid down policy, reloaded by cash or a debit to a bank account or maybe even through ATMs as allowed. So the correct answer will be option. Closed system PPIs are exempt. This is true, right? Semi-closed system PPIs can be used for cash withdrawal. No, they cannot be used for cash withdrawal. And open system PPIs can be issued only, they can be issued only by the banks, not by non-banks. All PPIs must have a minimum validity of 1 year. So the correct answer will be option B. Why the statement, correct statements, right? Yes. So the correct statements are 1 and 4 only. 2 and 3 are incorrect. 2 and 3 are incorrect. Everyone, please participate. Try to answer the questions. Yes. Option B is correct. Option B is correct. Okay. Next question. Consider the following statements about fund transfer and operational limits applicable to open system PPIs. Fund transfer to pre-registered beneficiaries is capped at 1 lakh per month per beneficiary. Fund transfer to non-registered beneficiaries is permitted up to 50,000 per month. The total outstanding balance in open system PPI cannot exceed 1 lakh at any point of time. Bank issuing open system PPIs must mandatorily allow cash withdrawal at ATMs, point of sale terminals, or business correspondence. What will be the correct answer? Which of these statements will be true? Which of these statements will be true? Read the second statement carefully. For the registered beneficiaries, it is 1 lakh per month. For others, what will be the limit? For others, what will be the limit? Fund transfer limits for all other cases is restricted to 1000 rupees per month. 1000 rupees per month. So the correct answer will be option A. 1, 3 and 4 only. Yes, not 1000, 10,000. Sorry, 10,000. Okay. So for this reason, 1, 3 and 4 will be correct. 1, 3 and 4, not all of the above. It is 10,000. Yes, not 50,000 but 10,000. So option A, 1, 3 and 4. Option A, 1, 3 and 4. 4 is also correct. 4 is also correct. Open system PPIs will allow cash withdrawal at ATMs, point of sale and business correspondent. Okay. Next. Which of the following statements is or are correct regarding the governance and loading of the prepaid payment instruments? PPI issuers must have a board approved policy for issuance and related activities of all PPI categories. Interest may be paid on PPI balances if the instrument is issued by a bank and linked to a savings account. PPIs may be loaded electronically only through instruments issued by regulated entities in India and in Indian rupees. Cash loading of PPIs is capped at 50,000 rupees per month, subject to an overall limit of the instrument. What will be the correct answer? 1 and 4, 2 and 3, option C, 1, 3 and 4, or option D, all of the above are correct. So the first statement is obviously true. A board approved policy is mandatory for issuance and operation. However, interest is not payable. No interest is paid on the PPI balances. No interest is paid on the PPI balances. Third statement is correct. It can be loaded electronically, right? And cash loading of PPI is limited to 50,000. Hmm. So what will be the correct answer? Which of these statements are true? Which of these statements are true? Correct statements. No, not A. The correct answer will be option C. Option C. Yes. 1, 3 and 4. 1, 3 and 4. All right. If we are loading or reloading, yes, if we are loading or reloading it electronically, it can be through approved instruments only and in Indian rupees. All right, so the correct answer will be C, 1, 3, and 4. Second is wrong. Interest is not paid on the PPI balances. Evaluate the following statements about the cross border outward transactions using Indian rupee dominated PPIs and choose the incorrect statement. You need to choose the incorrect statement. Statement 1 says only banks with authorized dealer 1 license may issue KYC compliant semi closed open PPIs for permissible current account transactions under FEMA. Such PPIs may be used for remittances under the liberalized remittance scheme if the issuer is a bank. Issuers must enable cross border outward transaction only upon explicit request from the PPI holder. If the PPI is issued in card form for cross border use, it must be EMV chip and PIN compliant. So, KYC compliant, obviously it should be reloadable, semi-closed and open system PPIs that have AD1 that have been issued by banks having the AD1 license. They subject to the normal guidelines governing the transaction. They can be used for cross-border transaction. However, they will not be used for any cross-border outward fund transfer or any remittances under the liberalized remittance scheme. Okay. Other than this, issuers will enable the cross-border outward transaction only on explicit request of PPI holders, and there will be a limit not exceeding 10,000 rupees, and per month will not exceed 50,000. Without reading all statements at once, declare wrong or right. If I declare it wrong or right, then how will you answer? I'm giving you the option to answer first, and then we are discussing the correct answer, right? So you need to select the incorrect statement. The incorrect statement will be option B. All right, PPI cannot be used for remittances under the liberalized remittance scheme. Second, you need to select the incorrect statement. Incorrect. That is why B is the option here. Right? Okay. Next. Evaluate the following statements comparing contactless cards and smart card. Which of the following statements are correct regarding the contactless cards and smart cards? Both contactless cards and contactless smart cards use the near field technology for wireless communication. Contactless cards are limited to 5,000 per transaction without PIN, while smart cards have no such limit. Smart cards can perform functions like data manipulation on chip, unlike contactless cards. Contactless cards are inherently more secure than smart cards due to pin-less convenience. Answer the question 12. Question number 12. What will be the correct answer? What will be the correct answer? Which of these statements are true? 1, 2, and 3, 1 and 3, 2 and 4, or all of the above? You're saying option C. Option C is 2 and 4. Do we need to select the incorrect statements? No, you need to select the correct statements. Correct statements. Both contactless card and smart cards, they use the near field technology. First statement is true. Okay. Third statement is also true. Smart cards can perform functions like data manipulation. They can add, delete, manipulate data on chip. However, the second statement is incorrect. It has been interchanged. The 5,000 rupees limit applies to the contactless transactions, not smart card usage. All right, it applies to the contactless transaction. And pinless convenience does not imply greater security. That would have to be stronger encryption. So the correct answer should be 1 and 3. Option B, 1 and 3 only. Option B, 1 and 3 only. All right? 1 and 3 only. Okay. Now this question is about the NEFT. Which of the following statements is or are true about NEFT operations and customer access? NEFT operates on a deferred net settlement basis and processes transactions in batches. Walk-in customers without bank accounts can initiate transaction up to 50,000 rupees per transaction. NEFT are transmitted through the structured financial messaging system. It allows two-way cross-border remittances between India and Nepal under the Indo-Nepal Remittance Facility Scheme. So, what is correct about the NEFT transaction? NEFT transaction. No, all the statements are not correct. Yes, the fourth statement is incorrect. The fourth statement is incorrect. Why? Because it allows only one-way transaction under the Indo-Nepal remittance scheme. See, it is written two-way cross-border transaction. No, it allows only one-way cross-border. Correct, correct. So the correct answer will be option A, 1, 2, and 3. Rest everything is correct. The transactions are completed in batches. 48 half hourly batches are available. Rest everything is correct. Just that about the Indo-Nepal remittance facility, it is a one-way transfer from India to Nepal. Both cash-based transaction and under the remittance facility scheme, the limit is 50,000 rupees. Right? So option A. Evaluate the following statements about the access criteria and classification of payment systems and select the incorrect statement. You need to select the incorrect statement. Centralized payment systems include RTGS, NEFT, NECS, and are open to eligible licensed banks. Centralized payment systems include MICR clearing houses and ECS and are open to all eligible licensed banks. Check truncation system centers are part of the decentralized payment system. Option D, NEFT enabled branches can receive funds but cannot initiate transactions unless the customer has an account. So, what will be incorrect? Incorrect statement. So, there are two types of payment systems. Two types of payment systems under which the remittance products work. Centralized payment system include RTGS, NEFT, NECS eligible for licensed banks. Decentralized include clearing centers, check truncation system, electronic clearing service. Why? Because we have the local regional centers. Yes, the correct answer will be option D. All right. Walk-in customers are also allowed. Walk-in customers are also allowed with the limit of 50,000 rupees to initiate the NEFT transaction. Evaluate the following statements about NEFT timing and settlement protocols. Destination banks must credit or return NEFT transactions within 4 hours of the batch settlement. NEFT operates 24/7, 365 days with 48 half hourly settlement batches daily. The first NEFT batch begins at 12:30 a.m. and the last ends at 12 a.m. midnight. Transactions initiated after banking hours are processed through the straight through processing. What will be the correct answer, everyone? Which of these statements are true? Option A says 1, 2, and 3. Option B 1 and 4. Option C says 2, 3, and 4. Or option D, all of the above statements are true. What will be the correct answer? What will be the correct answer? Yes, the first statement is incorrect. It should be completed within 2 hours of batch settlement. Correct answer is option C, 2, 3, and 4. Yes, everyone has answered correctly option C. So I hope there's no confusion in the NEFT part. Yes. Next. Evaluate the following statements about the ECS credit settlement and customer protection. Electronic clearing services. Correct. Chandan, correct. It is 2 hours, not 4 hours. The ECS center settles transactions by debiting the sponsor bank and crediting destination banks on the scheduled settlement date. In case of delayed credit, the sponsor bank is liable to pay penalty to the ECS user at RBI repo rate plus 2%. Penalty for delayed credit must be credited to the destination account holders without requiring a claim. The ECS user is responsible for communicating the credit details to the beneficiary, including date and amount. So, what is ECS? Where bulk and repetitive transactions have to be made. Bulk and repetitive transactions like salary, dividend, interest, or even collection of such transactions like premium, EMI, taxes, any charges. For that, ECS can be used. So, regarding the ECS transaction, what will be correct? First statement is true. First, the sponsor bank starts the transaction. The ECS user gives all the instruction, what amount, at what date, details of the beneficiary. However, Second statement will be incorrect in case of delayed credit. Not the sponsor bank, but the destination bank is liable to pay the penalty. All right, at RBI repo rate plus 2%. Okay, so the correct answer will be option B, 1, 3, and 4. 1, 3, and 4. Also, this is destination bank at prevailing LAF repo rate plus 2% from the due date of credit till the date of actual credit. Only one person has answered. Any doubt here? Is this question clear? So, how does the ECS work? The ECS, how does it work? Electronic clearing services, how does it work? the user the user submits the details of the beneficiaries like name, branch, account number of the beneficiary, MICR code of the destination bank, on the date on which the credit is to be afforded, right? So this bank is known as the sponsor bank. Then the ECS center will debit the amount of the sponsor bank on the scheduled settlement day, and for onward credit it will be sent to the destination bank branches. It can also be used for the NRE NRO account, fulfillment of the FEMA guidelines. In case of delayed credit, the destination bank would be liable to pay penalty, even without a claim by the destination account holder. Right? So the correct answer is option B, 1, 3, and 4. Question number 17. Which of the following statements is or are correct regarding the classification and operational jurisdiction of the ECS scheme? So ECS works at the local level, regional level, and the national level. You need to identify the correct statements. Local ECS is operated only by RBI and covers all branches within a state or a group of states. Regional ECS is operated at 9 centers and covers all core banking enabled branches within a state or a group of states. National ECS is centralized it at Bombay and covers all core banking solution enabled branches across India. NACH is a centralized ECS like system operated by RBI for pan India coverage. So, what will be the correct answer? Local ECS is operating at 81 centers or locations across the country. The branch coverage is restricted to the geographical coverage of the clearinghouse, one city or satellite towns and suburbs adjoining the city. They can be operated either by RBI or the designated banks. Regional ECS has 9 centers at various parts of the country, and it covers all core banking enabled branches in the state or group of states, right? And it is operated by RBI. National ECS is the centralized version of the ECS. The scheme is operated at Mumbai. All right. So, what will be the correct answer? The correct answer will be option B, 2, 3, and 4. Okay. Local ECS is incorrect. Right. It is B, 2, 3, and 4. Correct. Local ECS has 81 centers, a particular city, district, adjoining satellite towns. Rest everything is correct. Rest is correct. Now the ECS has been replaced by the National Automated Clearing House, and it has national footprint. It covers all over India. There's no requirement to identify whether to use the credit or debit under the local, regional, national, which category. NACH has central national footprint. Question number 18. Evaluate the following statements about NACH's operational capabilities and institutional design. NACH supports both credit and debit bulk transactions for government, corporate, and financial institutions. NACH allows member banks to design customized products while adhering to the NPCI's core standards. NACH does not support Aadhaar based transaction and is limited to account number based routing. NACH includes mandate management system and dispute management system for operational efficiency. Which of these statements are correct? Option A, only 1, 2, and 4. B, 1 and 3. C, 2, 2 3, and 4. Or option D, all statements are correct. About the NaCH. About the NaCH. Everyone answer it. A is okay. Yes, the correct answer will be option A, 1, 2, and 4. NaCH supports Aadhaar based payment system, the Aadhaar payment bridge developed by NPCI, so that the government and government agencies can make direct benefit transfer, okay, for government subsidies, benefits to the beneficiaries using their Aadhaar number. So the correct answer will be option A, 1, 2, and 4 only. And the third statement is incorrect. Question number 19. Which of the following statements is or are correct regarding the roles and regulatory status of the BBPS participant, the Bharat Bill payment? NPCI is the BBPCU responsible for clearing and settlement of transaction. The BBP OUs must be authorized by RBI, maybe banks or non-banks. Agent institutions operate under the BBP CU. They are directly responsible for onboarding agent. A biller may tie up with multiple OUs to access broader customer and payment channel coverage. So regarding the Bharat Bill Payment System, BBPS. Objective: an integrated bill system, interoperable, accessible bill payment services through a network of agents. There are multiple payment modes, instant confirmation of receipt. There are different parties involved. The central unit is correct. NPCI has been authorized by RBI as the payment central unit, responsible for setting business standards, rules, and procedures. The operating unit is an entity authorized by RBI. It could be a bank or a non-bank. They can choose to integrate with either the customer or the biller or both. Multiple is also allowed. Agents are entities who wish to offer, who are currently in the bill payment, collection, and aggregation. Agents could be business correspondent outlets, bank branches, collection centers, retail outlet. So, what will be the correct answer? The correct answer again will be option A, 1, 2, and 4. Third is incorrect. Third statement is incorrect. Right? Third statement will be incorrect. 1, 2, and 4 is true. Alright. Next. Question 20. Which of the following statements is or are correct regarding the origin and mandate of the Institute of Development and Research in Banking Technology, IDRBT? IDRBT. IDRBT was established in 1996 based on recommendations of the Saraf Committee constituted by RBI in 1994. The Saraf Committee emphasized the need for a centralized payment switch to be operated by NPCI. The IDRBT was mandated to spearhead technology absorption, focus on research and development. The External Expert Review Committee, chaired by Dr. C. Rangarajan, recommended that IDRBT expand its service portfolio to include retail payment operations. Regarding the IDRBT, what will be the correct answer? IDRBT. So basically, there was a felt need to increase technology absorption. For that very reason, the Saraf committee was constituted, right? The technology upgradation and payment systems. So the first statement is true in 1996. The Saraf committee, however, did not recommend for a centralized payment system. No. The Saraf committee recommended that there should be an apex institution that would undertake development and research in the area of information technology. So second statement is incorrect. Third statement says, yes, the third statement is correct. The role of IDRBT was to focus on research and development, give suggestions for information technology absorption in the banking sector. So third statement is correct. Fourth statement, however, the external expert review committee recommended that to function as a primary institute of excellence in the area of research, institute needs to shed its function of providing the various services. It should hive off its services, and yes, the technology solutions given by IDRBT like the NFS, Infinet, SFMS, they were handed over to other institute, right? The IFTAS was created for this purpose, and later on IFTAS was wholly acquired by RBI. So the correct answer will be option B, only 1 and 3. Only 1 and 3. Option C, 2 and 3. No, second statement is incorrect. Saraf committee's recommendation was to set up an apex institute that would give recommendation how to increase the technology absorption in the banking and financial sector. All right. So the correct answer is B. 1 and 3 only, and fourth is also incorrect. The explanation for it is given here. Question 21. Which of the following statements are correct regarding the design and operational advantages of Infinet? Infinet is a closed user group network that supports both interbank and intrabank applications across India. NEFT and RTGS transactions are routed through Infinet, critical backbone for real-time and deferred settlement systems. Infinet enables banking services independent of the location. It is operated by NPCI and integrated with the Aadhaar payment bridge for retail subsidy distribution. So what have we studied about the Infinet? About the Infinet. That it is a closed user group network, nationwide communication backbone for banking and financial sector, and various interbank, intrabank transactions using the messaging system, electronic fund transfer, electronic debit. All of this can be done using the Infinet, right? So, what will be the correct answer? What will be the correct answer? Statement 1 is true. Closed user group network. Yes. Statement 2 is also true. NEFT RTGS transactions are routed through Infinet. Infinet has centralized footprint, national footprint. Doesn't matter what is the location, the transactions can be done. Okay. And the statement 4, Infinet is operated by NPCI and it is integrated with the Aadhaar payment bridge for retail subsidy distribution. This we are talking about the NEFT, right? That is the NEFT, right? So the correct answer should be option A. It should be option A. 1, 2 and 3 only. 1, 2 and 3 only. Clear everyone? Yes? What are the advantages? Banking and financial services independent of their location, extended banking business reach, increased security, reduction of payment risk, efficient housekeeping, improvement in decision making, customer oriented delivery mechanism. So correct answer option A, 1, 2 and 3. Which of the following statements is or are incorrect regarding the cloud computing service model and deployment type? So we have studied about three types of cloud computing: software as a service, platform as a service, and infrastructure as a service. So first you answer, then I will explain. If you want me to do this, then first you answer. So the first statement says software as a service delivers software applications over the internet, eliminating the need for local installation or maintenance. So SaaS is an on-demand software, right? The software is provided to the end users so that they can run it on their own application. So the first statement will be correct. It is not an incorrect statement. Okay, it is not an incorrect statement. Platform as a service, it provides what? It provides a computing environment where the customers can build their own application that would run on the provider's infrastructure. Okay, so platform as a service is also correct. It is not incorrect. Third statement says hybrid cloud combines features of public and private cloud, can be used to balance scalability with data residency requirement. Hybrid cloud provides both. However, the statement D says infrastructure as a service offers virtualized computing resources, including servers and storage, but excludes network and data center provisioning. This statement is incorrect. Why? Because infrastructure as a service, it is a pool of equipment. Server, storage system, network, data center, everything is provided as a service to the customer where the providers can handle the customer's application. The customer can host their own software. Now, is it fine? Is it fine now? So the incorrect statement, you had been asked the incorrect statement, it will be option D. Option D is incorrect. Rest everything is correctly given. Is it fine now? Okay. All right. Question 23. A bank's internal audit team is reviewing 5 retail loan accounts for the special mention account classification. The following data is extracted. Now, recall what we have studied about the SMA classification in the recovery of retail loans, special mention account. If any account remains principal or the interest payment wholly or partly remains overdue between 1 to 30 days, it is SMA 0, 31 to 60 days, SMA 1, 61 to 90 days, SMA category 2. If interest or installment remains overdue for a period of more than 90 days, it is considered as a non-performing asset. If let's say if it is an overdraft or cash credit account that remains overdue out of order for more than 90 days, it is also NPA. Any bill remains overdue for more than 90 days, that is also NPA. These are the classifications that we have studied. So a principal is overdue by 29 days and the interest is overdue by 33 days. So it is overdue by more than 30 days. More than 30 days, between 31 to 60 days. That it will come under the SMA category 1. SMA category 1. EMI is overdue by 61 days. 61 days to 90 days, SMA category 2. Interest overdue by 89 days, principal not yet overdue. Doesn't matter whether the interest or the principal, anything remains overdue, it will be classified as SMA. So 61 to 90 days, this is in the SMA category 2 again. SMA category 2, right? EMI is overdue by 91 days, but the borrower has requested for restructuring. The borrower has requested for restructuring. For this reason, for this reason, I'm not getting the correct answers yet. Start answering, everyone. Start answering, everyone. What will be the correct answer? When the amount is overdue for more than 90 days, it becomes a non-performing asset and it will not be under the SMA category anymore. EMI overdue by 28 days, but the borrower has a sanctioned moratorium, Moratorium means holiday period has been given to the borrower, so the SMA category will not be there. So the correct answer, yes, the correct answer will be option 4. Right? Sorry, I did not give you the options. The options are 1, 2, 3, and 4 are correct. 1, 2, 3, and 4 are correct. The statement 5 is incorrect. All right? Statement 5 is incorrect. Why? Because it is still overdue. 0 to 30 days. It is still overdue. It will be in the SMA category 0. It will be in the SMA category 0. So 1, 2, 3, and 4 is correct. 1, 2, 3, and 4 is correct. Clear, everyone? Yes. More than 30 days, SMA category 1. More than 60 days, SMA category 2. More than 60 days, up to 90 days, SMA category 2 again. Now, more than 90 days, it comes under NPA. But the fourth statement says that, the fifth statement says that it is not classified as an SMA category, so this will be wrong. It will be in the SMA category 0. Clear? Clear, everyone? The correct answer will be option C, 1, 2, 3, and 4. Fifth statement is incorrect. Right? This is the SMA classification. 1 to 30 days, SMA 0. 31 to 60 days, SMA 1. 61 to 90 days, SMA category 2. Okay. A bank's financial controller is reviewing the interest income booked on the following account. Term loan classified as NPA on 31st March. Interest occurred till 28th of February. When we are talking about the interest income booked, what will be correct? Moratorium period has been given, but the account has already been classified as overdue. It is already classified as overdue. Doesn't matter whether moratorium has been given or not. Okay? It is already classified as SMA 0 because it was overdue for 28 days. Here are the options. Here are the options. Read the questions. Account A says term loan is classified as NPA on 31st of March. Overdraft account out of order till 50, since 15th of Jan and the interest is booked till 31st March. Advance against National Savings Certificate with adequate margin. Interest is due on 31st March. Bill discounted overdue since January 1. Interest is booked till 28th of February. Now go through the option. Interest booked on account A till 28th Feb must be reversed. If not realized, this statement will be correct. Right? If it is not realized, it will be reversed. Why? Because the account has been classified as a term loan. It has been classified as a term loan. Okay. Then the reversal applies to all the unrealized interest previously taken into the account. Okay, so the first statement is incorrect. Second, account B's interest booked till 31st March must be reversed again because it has been out of order. It has been out of order, so it will be reversed. The statement 3 says account C's interest may be retained on accrual basis, advance against NSC with adequate margin. That is, it has not yet turned into NPA. The first A and B account have already been out of order or classified as NPA. But the third account is still there with adequate margin. So it will be retained on accrual basis. Statement 4, account D's interest must be reversed only from 1st March onward. No, this statement will be incorrect. Why? Because the reversal applies to all realized interest previously taken into the profit and loss account. Right? not just post March period. So that is why the correct answer will be option A, 1, 2 and 3. 1, 2 and 3. Okay, option A, 1, 2 and 3 will be correct. Right? So when does an account become NPA? Where the interest or the installment principal remain overdue for more than 90 days. In case the account remains out of order, if it is an overdraft cash credit account, it remains out of order for a period of more than 90 days. A bill has been purchased and discounted, remains overdue for a period of more than 90 days. Recognition of income in this is based on the record of recovery. It is not recognized on accrual basis. Thus, it will be reversed. Okay? The entire interest accrued and credited to the income account should be reversed if it is not realized. If it is not realized. Thus, the correct answer was option A. Okay? 1, 2, and 3 only. Hmm. Next. A borrower has the following facilities with a bank: a term loan overdue for, why not 4? Because here it is saying that interest must be reversed only from March 1 onwards. No, it has been booked till 28th of Feb. That is why the fourth statement is incorrect. So the explanation has been given. The account D is incorrect because the reversal applies to all unrealized interest previously taken into the profit and loss account, not just the post March period. That is why fourth is incorrect. Okay. Fourth says only that which happened post March will be reversed. Right? But all the unrealized interest should be reversed. Clear now? Why option D? Why the fourth statement is incorrect? Interest reversal, where the bank cancels out the unrealized interest that was previously recorded as income. Why? Because the borrower is not servicing the loan anymore. So the bank removes this uncollected interest from its profit. Right? Bank has removed this unrealized interest from its account because it is not paid by the borrower. All right? This is because of RBI's prudential norms. Banks are not allowed to recognize income on an accrual basis for NPA. If an account has become NPA, any interest accrued and credited to the income account in the past period must be reversed. That is, it will not be taken into account as an income of the bank. That is the meaning of interest reversal. Okay, clear now? Right. Let us move on to the next question. Facility A. Term loan overdue for 14 months secured by property with realizable value at least 60% of the last assessed value. Overdraft account overdue for 10 months secured by shares with realizable value of 8% of outstanding. Bill discounted overdue for 13 months. No security is available. Which of these statements are correct? Which of these statements are correct? If the term loan is overdue for 14 months and the it is secured by the property with realizable value at 60%. If it is less than 50%, then we will classify it as the doubtful category 1 straight away. Okay? Then it will be classified as the doubtful category 1 straight away. But in this situation, It will be still in the standard asset. So the first statement should be incorrect. Okay. Second facility, overdraft account overdue for 10 months, secured by shares with realizable value of 8% of the outstanding. Less than 10% remaining, we classify it straight away as the loss asset. We classify it as straight away loss asset. So it will be a loss asset. Second statement is true. Third statement says facility must be classified as doubtful category 2. Bill discounted overdue for 13 months, no security is available. This will be classified again as a loss asset, not a doubtful category 2. All right? Because no security is available here. All facility must be classified borrower wise and not facility wise. So the correct answer should be 2 and 4 option B. 2 and 4 option B. First statement and third statement is incorrect. Right? Facility A will be a substandard asset because realizable value is 60%. If it was less than 50%, then we would classify it in the doubtful category. Third statement is also incorrect because this will be classified as a loss asset. Loss asset. All right? Yes, so the correct answer is option B. And the fourth statement is correct. All facilities are classified borrower wise, not facility wise. All facilities must be classified borrower wise, not facility wise. Clear? Okay. A bank is evaluating three non-performing asset accounts. Account A is NPA for 6 months. Security value assessed at 45% of the last inspection value. Account 2, NPA for 3 months. Security value assessed at 9% of the outstanding. Account C, NPA for 14 months. Security value assessed at 55% of the last inspection value, but more than 12 months. See, when we are talking about the doubtful category, substandard asset means which has remained NPA for a period of less than or equal to 12 months. More than that, up to 12 months, doubtful category 1. 12 months up to 3 years, doubtful category 2. More than 3 years, doubtful category 3. However, if there is erosion in the value of security, when the realizable value of the security is less than 50%, then straight away we will classify it as the doubtful category. Right? It is not less than 50%. Read the statement clearly. It says realizable value is 60%. If it had been less than 50%, then we would classify it as doubtful category 1. Okay, it is more than 12 months, but the realizable value more than 12 months up to 12 months. Substandard asset means more than 12 months up to 12 months. It should be doubtful category. Okay, I'll have to explain this. Wait. Hmm. See, what happens is, let's say an account became NPA in July, right? Not NPA, it became NPA in July. That means it has already been overdue for 90 days. Now more than 90 days. More than 90 days up to 1 year will be substandard category. Up to 1 year will be substandard category. So from July 2026, when will it enter into the substandard category? NPA for a period of less than or equal to 12 months. For another 12 months, it is still in the substandard category. Still in the substandard category. Now, after, if it has remained NPA for more than 12 months after that, then it will be classified in the doubtful category 1. Okay? For the first 12 months, it is in the substandard.
Realizable values more than 60%, so it is not considered as doubtful category. Yes. If the realizable value had been less than 50%, then we'll classify it as the doubtful category 1. 12 months plus 12 months, doubtful category 1. 12 months up to 3 years, doubtful category 2. More than 3 years, doubtful category 3. Okay? All right? Now come to this question. Account A must be classified directly as doubtful due to significant erosion of the security. Is this statement true? Yes, it is true. Although it has remained NPA for 6 months only, according to it, it was in the substandard category only. But the realizable value is less than 50%, so it will be in the doubtful category. Statement 1 will be incorrect. Statement 2 says account B will be classified as loss asset. Yes, although it has been NPA for 3 months only. According to it, it should be in the substandard category. But the security value is less than 10%. So it will be in the it will be in the loss asset. It will be in the loss asset. Third statement says that account C must be classified as doubtful category 2. NPA for 14 months, security value is still 55%. So it will not be in the doubtful category 2. It will either be it could be in a substandard category or in the doubtful category 1. Probably in the doubtful category 1. All right, it could be both. Statement 4 says account A cannot be classified as doubtful unless it completes 12 months of NPA. Incorrect. If the realizable value of the security becomes less than 50%, we will straight away classify it as a doubtful category. So the correct answer should be option A, 1 and 2 only. 1 and 2 only. Clear? Everyone? Yes, the correct answer will be option A, 1 and 2 only. Remember the points. All of these are interrelated. They are interrelated. So you need to keep in mind that the period for NPA plus the realizable value will be considered. Hmm. Okay, the answer is already given here. Let us for once ignore it. Account A is classified as doubtful category 1. Doubtful category on 1st of January 2023. Today is 15th November 2025. It was account B was classified as doubtful on 1st December 2024. Account C is classified as doubtful on 1st October 2022. You need to keep in mind the date given today is 15 November 2025. A is what category? A will be classified in the doubtful category. See, the statement A is correct, right? It is in the doubtful category. It will be in the doubtful category. Less than 50%, we will place it straight away in the doubtful category, not in the substandard. If it was more than 50%, then we could have kept it in the substandard category. Coming back to this question, evaluate the statements, take your time, evaluate it. The option says account A is classified as doubtful category 3. Doubtful category 3 would be more than 3 years. More than 3 years. 1st January 2023 to 1st January 2024. 1st January 2025. 1st January 2026. So no, it will not be classified in doubtful category 3. It will be doubtful category 2. First statement is incorrect. Second, account B is doubtful category 1. B means that within 12 months. So 1st January 2023 to 1st January 2025. 24. It is in the doubtful category 1. Up to 3 years, yes. It will be in the doubtful category 1. Correct. So this statement will be true. It is in the doubtful category 1. It will not enter into the doubtful category 2. Okay. Then account C is doubtful category 2. Account C says it turned doubtful on 1st October 2022. So doubtful category 2 means remained in the doubtful category up to 3 years. Up to 3 years. So 1st October 2022 to 1st October 2023, 1st October 2024, 1st October 2025. It is in the doubtful category 2. So this will be correct? Yes? Will it be in the doubtful category 2? Today is 15th of November 2025. And the fourth statement says account B will become doubtful on 1st December 2025. Account B is classified in doubtful category 1 on December 2024. To become doubtful category 2, it should be overdue for more than 12 months up to 3 years. Okay, so from 1st December 2024 to 1st December 2025, it will enter into the doubtful category 2. Yes, so this will be incorrect and the fourth statement will be correct, right? Four are correct. Four are correct. 2 and 4 is correct. 2 and 4. Okay. Statement C will be doubtful category 3 and account B will be classified in the doubtful category 2 on 1st December 2025. All right. Hmm. Yes, so the correct answer is option C, 2 and 4 only. 1 and 3 are incorrect. 1 and 3 are incorrect. I know this is a bit tricky, but if you understand the concepts well, take your time and then answer. Correct answer will be option C. Question number 28. A bank is assessing the provisioning for a term loan account classified as doubtful category 2. The following details are available. Outstanding balance of 10 crore rupees, realizable value of security 6 crore rupees. The account has remained in the doubtful category for 2 years and 4 months. Which of the following statements will be correct? Which of the following statements will be correct in this scenario? Whether the term loan has been classified as doubtful category 2 or not. 2 or not. So the outstanding balance, okay, I will explain it. Okay, don't worry. The outstanding balance is 10 crore rupees, but the realizable value of the security is more than 50%, more than 5 crore. Okay, so the 50% part we can remove it. And the account has remained in the doubtful category for 2 years and 4 months. That is less than 3 years. Less than 3 years. That is why it is classified in the doubtful category 2. So 4 crore unsecured portion must be provided at 100%. Now, when we are talking about the provisioning norms, loss asset should be written off. If for any reason the loss assets are permitted to remain in the books, 100% of the provisioning should be provided off. In the case of doubtful, it is a second doubtful category 2 asset, right? So for the uncovered part of the advance which is not covered by the realizable value, 100% should be provided for. So the first statement will be correct. It is in the doubtful category 2. 4 crore is the unsecured portion, must be provided with 100% provisioning. Okay. First statement is true. In regard to the secured portion, provision will be made on the basis like up to 1 year 25%, 1 to 3 years 40%, more than 3 years 100%. But here it is a doubtful category 2. That is why the secured portion will be provided at 40%. Right? If it was in the doubtful category 1, then 25%, doubtful category 3, then 100%. It is the doubtful category 2, that is why 45%. So the second statement is also correct. Okay. Total provision required will be 7.4 crore. And the fourth statement is, if the security was valued at 2 crore instead, the total provision would be required at 10 crore. So now you need to calculate the total provisioning. Calculate it for me. 100%, 4 crore 100% plus 6 crore 40%. Right? So what is the total provision required here? What is the total provision required here? What will be the correct answer? The total provision required. 6.4%. It is not 7.4%. It is 6.4%. Very easy, right? So the third statement will be incorrect, and the correct answer will be option C, 1, 2, and 4. 1, 2, and 4. If the security was valued at 2 crore instead, 2 crore instead, this was not 6 crore but only 2 crore, then total provisioning required would be 10 crore. That is less than 50% is remaining. So 100% provisioning should be done. Clear now, everyone? Yes, so the correct answer will be option C, 1, 2, and 4. 1, 2, and 4. Okay. A bank has the following substandard exposures. Account A, 5 crore overdraft secured by tangible stock, realizable value of 0.4 crore. Account B, 3 crore term loan secured by corporate guarantee. Account C, 2 crore letter of credit developed, no security. Account D, 4 crore term loan secured by plant and machinery, realizable value of zero point 0.6 crores. So, in the first account, you can see that the security value. Now, what is this? Now, when we are talking about substandard asset, what is the general provisioning required? Normally, 15% is required on the total outstanding, right? Total outstanding without making any allowance for securities available. The unsecured portion would attract additional 10%. Additional 10%. Right? This is what we have studied. The unsecured exposure where the realizable value of the security does not cover. It is not more than 10%. Right? More than 50% will be calculated on outstanding. Uh, what? Okay. So what will be the correct answer here about the substandard asset? First account, security value is less than 10% of the exposure. So we will require 15% plus 10%, total 25%. Correct? Right? Correct. Second account is unsecured as corporate guarantee is not a tangible security. So it will be considered as unsecured. Right? This statement will also be correct. Account C is unsecured and attracts 25%. No securities there, so automatically 25%. Account D is secured and attracts 15% provisioning. This will be incorrect, right? The security value is 15% of the exposure. It is secured more than 10%, more than 10%. So it will attract 15% provisioning, right? So remember the category when we are talking about the substandard asset, it will depend. A general provisioning of 15%, general provisioning of 15%, and any unsecured exposure, additional provisioning of 10%. Right? So additional will be required here. Additional will be required here. Realizable value is only 0.6 crore. So it will attract 25% provisioning, not 15%, but 25%. Okay, question number 30. I think this was the part for the doubtful category. Yes. Hmm. Consider the following statements regarding the legal provisions of the SARFAESI Act. What is the SARFAESI Act? When the banks are given the option, they can recover their loans without the involvement of any court. Without the involvement of any court. The SARFAESI Act overrides the provisions of the Companies Act 2013 in matters of enforcement of security interest, including the liquidation. Yes, the SARFAESI Act has been enacted so that the banks can take over, they can give the notice to the borrower, take possession of the property, sell the security, and recover their dues. So it has overriding provision over the Companies Act, Transfer of Property Act. First statement is correct. Second statement, the Act's overriding clause are subject to the IBC code also. Yes, it also overrides any other code. In case of conflict between SARFAESI and Transfer of Property Act, the latter prevails. No. In case there's a conflict, there is some contravening provision between the SARFAESI Act and the Transfer of Property Act, then the SARFAESI Act is going to prevail, not the Transfer of Property Act. Okay, not the Transfer of Property Act. Start answering, everyone. So the third statement will be incorrect. Third statement is incorrect. The provisions of SARFAESI Act can be invoked even when proceedings under the DRT are pending and the creditor has not yet obtained the recovery certificate. Yes, so the correct answer will be option C, 1, 2, and 4. Okay. So the SARFAESI Act gives the option to the creditor. They can initiate proceedings even if there are pending proceedings under the DRT Act. It has overriding powers over all the other acts, the SARFAESI Act. All right. Gives the bank power to recover their dues without any court intervention. Without any court intervention. So the correct answer will be 1, 2, and 4. Which of the following statements are accurate in the context of registration and priority under the SARFAESI Act? Registration of a security interest with the central registry is mandatory for its enforceability under SARFAESI Act. Only secured creditor, right? When we are talking about the SARFAESI Act, only secured creditor can enforce the security interest. They have to be registered. However, this is in terms of the priority. A registered security interest takes precedence over an unregistered charge under the Companies Act 2013. The central registry is empowered to adjudicate disputes regarding priority of charges between multiple secured creditors. Delay in registration of the security interest may affect the priority of charge, but not the validity of the underlying security. Why am I not getting answers? Answer this question. What will be the correct answer? Everyone. What will be the correct answer? So the first statement is correct. Registration of a security interest with the SARFAESI is mandatory. True, right? And a registered security interest takes precedence over an unregistered charge. This is the priority. Secured interest gets priority, the secured creditor gets priority. if there are two creditors and the borrower owes debt to both of them. The creditor who got the charge registered first will be given priority. Okay, right? The central registry is empowered to adjudicate the disputes regarding priority of charges between multiple creditors. I am declaring option wise, but I'm not getting answers. Here, all the options will be correct. Option D, not option A, but option D. All of the above will be correct. What have we studied about the SARFAESI Act? SARFAESI Act, basically, it is a major change in the legal framework for the securitization of financial assets, reconstruction of financial asset, recognition of any interest created in the security, right? And the loan must have been classified as NPA. Outstanding should be more than 1 lakh, or the outstanding due should be 20% or above. However, however, the documents should be enforceable an unexpired period of minimum 6 months, and the secured asset should not be an agricultural land. If there are multiple lenders, consortium advances, then those lenders that have a minimum of 60% of the dues outstanding, they will initiate the SARFAESI. Overdue period, the date from which the account, facility wise security, everything will be determined as per the SARFAESI Act and registration with the SARFAESI. Okay, so the correct answer is D. Which of the following statements regarding the demand notice and the borrower's response are accurate? So, the first step to initiate the SARFAESI power by the secured creditor is that they have to give a notice. They have to issue a notice to the borrower to fulfill the obligation, pay the whole debt within a certain time period. So the notice must be mandatorily disclosed, the date of NPA classification and facility wise security details. When the secured creditor is to give a notice to the borrower, what they will include: a notice to discharge the dues in full within 60 days. Only two particulars are mandatory: details of the amount payable and the details of the security. Only these two are compulsory. Other than this, overdue period, the date from which the account became NPA, or the facility wise security can be provided in the notice if the secured creditor wants, otherwise not. All right. So it is not mandatory. It is not mandatory. Second statement: the borrower's representation must be replied to within 15 days, failing which the enforcement action becomes invalid. Now, when the borrower makes a representation, right, they raise any obligation, the secured creditor has to communicate his reply to the borrower within 15 days of the receipt, right, on such representation. So within 15 days it has to be made. Second statement will be correct. The notice must be served to all the obligors, including the guarantors and mortgagors, not just the principal borrower. Yes, the 60-day period begins from the date of the issuance, not from the date of receipt. No, the correct answer should be 2 and 3. 2 and 3. Okay, 2 and 3 only. The date from the receipt of the notice by the borrower. On receipt of the notice, the borrower is given time that they can make or raise any obligation to the secured creditor. Okay, so the correct answer should be 2 and 3. 2 and 3. Clear? The correct answer is option D, 2 and 3 only. Which of the following procedural requirements are mandated under the SARFAESI Act or its rules during the possession of secured asset? Possession of movable assets must be taken in the presence of two independent witnesses and an inventory must be prepared. In case of immovable property, symbolic possession must be followed by physical possession within 30 days. Now, when we are talking about the possession of security, if the borrower fails to comply with the demand notice, then the secured creditor may take recourse to the recovery measures. It can include taking possession of the secured asset for their realization, taking over the management or appointment of any receiver. When the possession is taken, it should be taken only by the authorized officer in presence of two witnesses. Okay, after this, let us do till 35 questions, two more, and then we will take a break. Right? In the presence of two witnesses, the possession should be taken. So, this is correct. And when we are talking about possession of the immovable property, what is to be done? The affixing of the possession notice on the outer door should be done, wherever the immovable property is situated. Right, at the outer door it should be done. However, any physical possession within 30 days is not required. Symbolic can also be done. Symbolic can also be done, a fixation of the notice. So second statement is incorrect. Third statement, yes, once the possession notice is affixed on it, it also needs to be published in two leading newspapers within 7 days. Two leading newspapers that are widely in circulation, right? The authorized officer will affix a possession notice and publish it in two leading newspapers. So, statement 3 is also correct. Perishable goods must be disposed of within 15 days of possession. There's no requirement of exact 15 days, right? The basically they should take care of it that extra charges are not incurred, but it is not necessary that within 15 days only it should be sold off or it should be disposed of. So the correct answer should be option A, 1 and 3 only. 1 and 3 only. All right? 1 and 3 only. Okay, next. Which of the following statements are true regarding the borrower's right to redeem the secured asset? The borrower may redeem the property by paying the dues in full at any time before the auction is conducted. Redemption is possible only before the publication of auction notice or invitation for private treaty. Once the auction notice is published, the borrower loses the right to redeem the property even if the auction has not yet occurred. So, before the auction is conducted, yes, the borrower can pay the full debt and redeem the property. And redemption is possible only when the publication, before the publication of the notice, correct? Once the auction notice is published, the borrower loses the right to redeem. No, if the auction is not yet completed and the creditor is fine, they are okay to accept the payment, they will return the secured asset back to the borrower. Borrower will not lose the right to redeem the property. So the third statement is incorrect. The mortgager's right to redeem is extinguished once the sale is concerned. Yes, this is now true. The borrower will lose the right to redeem the property when the property is already sold to a third party. Any action by the mortgager now will not affect the right of the third party. So the correct answer will be option C. 1, 2, and 4 only. Third statement is incorrect. Question number 35. Which of the following statements does not correctly reflect the jurisdictional scope and statutory implication of the DRTs under the Recovery of Debts due to Banks and Financial Institutions Act of 1993? So, in the RDB Act, special courts are set up. The Debt Recovery Tribunal and the Debt Recovery Appellate Tribunal. DRT has original jurisdiction, DRAT has appellate jurisdiction. These are established by the central government. You need to mark the incorrect statement. Statement A says the act applies to the entire territory of India. including union territories, but excludes the state of Jammu and Kashmir. Correct, right? DRTs can entertain applications from borrowers under SARFAESI Act even though the RDB Act primarily empowers banks. True. Under the SARFAESI Act, the borrowers can become the first applicants if the borrower is aggrieved by any action taken by the creditor. They can make their complaint to the DRT. All right. So B is also correct. The establishment of a DRT in a region is contingent upon the volume of the cases. Yes, more number of cases, more number of DRTs will be established. If statement 3 is correct, 2 is wrong. If statement 3 is correct, 2 is wrong. Why? DRTs can entertain applications. No, both are correct. And statement D says DRTs are empowered to adjudicate dispute. No. Breach of contract or deficiency of service falls under the ombudsman scheme, the integrated ombudsman scheme of RBI, or the separate ombudsman schemes that were existing before it. So the statement D is incorrect. You were asked which statement is not correct. So the correct answer will be option D. All right, option D will be incorrect. Clear? Yes? Okay, so now let us take a 10 minutes break. Let us take a 10 minutes break and we will continue at 8 p.m. All right? A 10 minutes break and then we will continue. We have many questions left. So after the break, we will continue for another 2 hours. Okay? Please give chance to us for 5 answer. Give answer. See, some of you are telling me, saying that you want me to explain the options immediately. Others are saying that you want to answer it first. Okay. Okay, so let us take a 10 minutes break and then we will continue. All right, let us continue. Okay, everyone's back. All right, so here's the next question. Which of the following statements correctly reflect the interplay between SURFACE and the DRT mechanisms? Under the SURFACE, the borrower becomes the applicant before DRT. Under Section 17, to challenge the possession or sale actions. Appeal against DRT orders under the SURFACE must be filed before DRAT within 30 days, accompanied by a mandatory deposit of 75% of the debt amount. DRAT is presided over by a chairperson who must be or have been a High Court judge. DRAT has original jurisdiction to entertain recovery applications from banks and financial institutions under the SURFACE Act. So this is a combination question of both Recovery of Debts Due to Banks Act and the SURFACE Act. DRT Act is the same. RDB Act and DRT Act are the same thing. So what is correct? Under the SURFACE Act, banks they initiate the process, but if the borrower is aggrieved by any action taken by the bank, they will become the first applicant to challenge the action. So the first statement, okay, you have answered option B. All right. Hmm. So the first statement will be correct. Now, appeals against DRT orders, yes, will be filed before DRAT within 30 days. Correct, but the deposit required is 50%, not 75%, and it can be reduced to 25% as well. DRAT is presided over by a chairperson who has been a High Court judge or who is qualified to be a High Court judge. Presiding officer of the DRT should have the qualification of a district judge. Right. And the fourth statement, DRAT has appellate jurisdiction, not original jurisdiction. Original jurisdiction is with the DRT. That is why the correct answer is option B, only 1 and 3. Only 1 and 3. Next. Which of the following statements accurately describe the legal status and enforceability of awards passed by the Lok Adalat? Lok Adalat. An award passed by Lok Adalat is deemed to be a decree of civil court and is executable accordingly. No appeal lies against the Lok Adalat award even if one party alleges coercion or misrepresentation. Awards passed by Lok Adalat are binding only if both the parties have signed the settlement terms. In case of default on an one-time settlement routed through the Lok Adalat, the award can be executed like a civil decree without filing a fresh suit. So the Lok Adalats are established under the Legal Services Authorities Act. They can be established by the central authority, state authority, district or taluk authority as well. It is the cheapest, fastest, safest mode of recovery for debt amount less than 20 lakh. The Lok Adalat, they conduct mediation, arbitration, they try to achieve a common ground, something which is acceptable to both the parties, and with the consent binding orders are passed. Without the consent binding orders cannot be passed by the Lok Adalat. Okay. However, normally when an award is passed by the Lok Adalat, no appeal can be made against the award of the Lok Adalat. But if one party tries to achieve the other party's consent by coercion or misrepresentation, then the writ jurisdiction of High Court and Supreme Court will be applicable. Okay. First statement is thus correct. It is deemed to be a decree of civil court. Second statement is incorrect. If the award is passed with the consent of both the parties, then it will be binding. No appeal can be made. Okay. Second statement is incorrect. Third statement is correct. Fourth statement is also correct. If someone tries to contravene the decision awarded by the Lok Adalat, then the execution petition proceedings will start immediately, recovery will start immediately without filing a fresh suit. If it was a transferred case from a civil court to the Lok Adalat, then also the civil court will start from the point it had been transferred. So the correct answer will be option A, 1, 3, and 4. Option A, 1, 3, and 4 will be correct. No, B and D will not be correct. Third statement is also true. It is binding only if both the parties have agreed to it. Only consent, with consent, an award can be passed. Next. Which of the following statements correctly describe the eligibility and referral process for NPA cases to the Lok Adalat? NPAs with dues up to 20 lakhs, whether secured or unsecured, are eligible for referral to Lok Adalat. Banks must file a consolidated petition for all eligible accounts before the Legal Services Authority. Exclusive Lok Adalats may be organized for a bank's case if the number of eligible accounts is substantial. Suit filed cases exceeding 20 lakh can be referred to Lok Adalat only with special permission from the DRAT. So, what will be correct? Option A, only 2 and 4. Option B, 1, 2, and 3. Option C, 1 and 3. Or option D, all of the above. What will be correct? What will be correct? You're saying option B. Okay, so let us go through the statements one by one. Till then, everyone answer the question. NPAs, whether secured, unsecured, yes. In the case of SARFAESI or RDB, only secured cases could be taken. But in case of the Lok Adalat, both secured, unsecured are eligible. Amount should be less than 20 lakh. Okay. Banks must file a consolidated petition. No, separate petition should be passed. Banks will identify all the accounts which have turned NPA and they will file it separately. Exclusive Lok Adalat can be organized. A bank itself can organize a Lok Adalat if the number of eligible accounts is substantial. Right? So the third statement will be correct. However, suit filed exceeding 20 lakh cannot be permitted even if approved from DRAT. When a Lok Adalat is established in the area, the DRT, DRAT, they are not going to have any jurisdiction. Okay, either the case could be made to them or to the Lok Adalat, and the cases can also be transferred to the Lok Adalat. If it is not resolved by Lok Adalat, then it can be transferred back to the civil court or the DRT, DRAT, wherever it was pending. So the correct answer should be option C, 1 and 3 only. 1 and 3 only. Okay, 2 and 4 is incorrect. 1 and 3 only. When we are talking about the award passed by Lok Adalat, the process which is followed by Lok Adalat, one time settlement. What will the banks do? They will identify the dues up to 20 lakh, irrespective of whether secured or unsecured. Bank will prepare a petition separately for each account. These identified cases are referred to the Lok Adalat organized by the respective legal services authority. The district or the taluk authority can also be approached by the bank directly. Banks can organize the Lok Adalat in association with other banks also. Okay? So the correct answer will be option C, 1 and 3 only. Second statement will be incorrect. In the context of securitization, which of the following best describes the role of originator? What is securitization? Wherein the lender, wherein the lender they create a pool of homogeneous asset or performing asset, they transfer it to the special purpose vehicle to get more liquidity, right? And the special purpose vehicle makes an immediate payment to the lender. Then the special purpose vehicle can recover it from the borrower. or they can create security interest, tradable securities in which the qualified institutional buyers are going to invest, right? So, which of the following will be correct? A person who promotes the bankruptcy remote entity for asset pooling, the person liable to discharge obligations under a debt instrument, a person or company that transfers assets from its balance sheet to an SPV, or a trustee managing the receivables on behalf of the investors. Yes. The correct answer will be option C. Originator is the bank, lender, creditor, which is transferring assets from the balance sheet to a SPV. Person who promotes a bankruptcy remote is known as the sponsor. Person liable to discharge the obligations are known as the obliger or the borrower. Trustee for separate schemes, trusts are created. The correct answer will be option C. Okay. The definitions of all the entities involved is given. A bank disburses a car loan with fortnightly repayment and original maturity of 18 months based on RBI's minimum holding period norms. Which of the following will be true? The loan can be securitized after three fortnightly installments. The loan requires six fortnightly installments before securitization. The loan is ineligible due to short tenor. The loan requires nine frequently installment. So fortnightly installment, original maturity of 18 months. Recall what we have studied about the minimum holding period. The minimum number of installments that have to be made so that it is shown that it has a recoverable feature. Banks, they do not transfer the project implementation risk to the SPV. So loans with original maturity up to 2 years. Repayment frequency is given fortnightly. What is required? The loan maturity is up to 2 years and the repayment frequency is given fortnightly. How many fortnightly repayments should have been made? Then the bank can transfer it to the SPV. What will be the correct answer? Three installments, six installments, ineligible, or nine? Yes, the correct answer will be option B. Option B. Loans that have original maturity up to 2 years and frequency is fortnightly, then six have to be made. If frequency is weekly, then 12, monthly, then 3, quarterly, then 2 installments are required. And when we are talking about the loans which have original maturity of more than 2 years, up to 5 years, then it becomes 18 weekly, 9 fortnightly, 6 monthly, and 3 quarterly. All right. So the correct answer will be option B. Six fortnightly installments should have been made. 2 weeks. Fortnightly means 2 weeks. Around 200 questions are there that we need to solve. So we have to increase our speed. Okay. So the correct answer is option B. This is the table for the minimum number of installments for your reference and revision. Consider the following statements regarding minimum retention requirement. MRR must be maintained as a percentage of unamortized principal. MRR can be reduced through sale of retained interest. MRR must be remained unchanged throughout the securitization life cycle. MRR is applicable only to the loans with maturity exceeding 24 months. What will be correct? Now, what is minimum retention requirement? This is basically banks, the originating banks, they should have a continuing stake in the performance of the securitized asset. That is why RBI has given guidelines that a certain percentage of the book value of the loans being securitized should be retained by the bank and remaining can be transferred to the SPV. All right. So what is the MRR requirement? 5% is required with the loans that have an original maturity of 24 months or less, and 10% with original maturity 24 months or more. For bullet repayments, it is 10%. It has to be maintained with the by the entity, that originating entity, and it should not be reduced either through hedging or credit risk or selling the retained interest. It should be an unamortized principal maintained on an ongoing basis. All right. So, what will be the correct answer? First statement is correct. MRR cannot be reduced. So, second statement is incorrect. MRR must remain unchanged. So, third statement is correct. MRR is applicable only to loans with more than 24 months. Incorrect. Less than 24 months, 5%. More than 24 months, 10%. So, the correct answer will be option A, 1 and 3 only. Clear, everyone? Option A, 1 and 3 only will be correct. Yes, correct? Okay, next. Consider the following statements about investment classification post sale to the asset reconstruction company. Now, when the banks transfer their asset to the SPV or the ARC, can the bank themselves invest in the instruments issued by ARC or not? Bonds or debentures received from ARCs are treated as investment. Second statement, security receipts and pass-through certificates issued by ARCs are classified as advances. Banks may invest in instruments issued by ARCs. Sale consideration must be in the form of equity shares. Now, when the bank has transferred the asset to the ARC will do what? What will be the correct answer? What will be the correct answer? Banks are allowed to invest in the bonds, the securities issued. When the ARC is making them the payment, they can also issue bond or debentures, right? Banks, financial institution may receive cash or bond or debentures as sale consideration for the financial assets sold to ARC, and these will be treated as classified as investments in the books of banks. Banks can also invest in the security receipts, pass-through certificates, or the debentures issued by ARC. They will also be classified as investments in the books of the bank. All right. So 1, 2, and 3 should be correct, and fourth should be incorrect. No, these are not classified as advances. These are classified as investments. So option A, 1 and 3 will be correct. Uh, expect till at least 11. Till 11, we will take on the session. We'll try to cover as many questions as possible. Others, I will upload the PDF for you for your revision. All right. By 11, we will wind up. So the correct answer here is option A. Sale consideration cannot be equity shares of the ARC. They could be bonds, debentures, which will be treated as investment, but not as advances of the bank, not as loans of the bank. Correct answer, option A. As per the RBI norms, what is the minimum investment an ARC must make in the security receipts under each scheme? Now, when the ARC is receiving the assets transferred by the originating bank, they also need to have a continuing stake in it, right? Every ARC shall issue the security receipts through the set trusts which are set up by them, right? And these are issued only to the QIBs. They are transferable, assignable in favor of other QIBs only. Every ARC is also required to invest in the security receipt an amount not less than Some of you are saying 10%, others are saying 20. The correct answer is 15%, minimum 15% of the scheme. An ARC shall invest in the security receipt set up by the trust for an amount not less than 15% under each scheme, not 10 but 15. All right, they'll have to invest minimum 15% in each of the scheme. Okay, so here's an important information for you. The class that we conducted yesterday, if you want to download the summary PDF, you need to go on the Oliveboard app and log into your account. Then change the category to JIB and CIB. Under that, select for the JIB Super Elite course. The PDF is free of cost for everyone. You need not subscribe for the course. Simply open the batch. From that, select the All tab, scroll down, and you will find the RBWM summary PDF. You can download it. Okay, you can download it. This class PDF I will also upload once the class is over. In the same manner, you can download it. It is only available under the batch. Okay. So go to the Oliveboard app. Under the JIB Super Elite plan, you will get the summary PDF. After the class, not now. Do not leave the session right now. Okay. With reference to the IDRCL, consider the following. IDRCL was incorporated in September 2021. It has authorized capital of rupees 50 crore and paid up capital of rupees 20 crore. State-owned banks hold 49% stake in IDRCL. IDRCL is responsible for issuing security receipts to the QIBs. It is there. This class PDF I will upload once the class is over. I myself have downloaded the PDF. I will show you. I can open it on my app on the phone and I can show it. But let us complete a few more questions and then we'll do that. All right? Hmm. So answer this question. We have studied about the bad bank framework, the NARCL and the IDRCL. Okay. So what will be correct? So IDRCL incorporated on 3rd September 2021. Authorized capital of 50 crore, paid up capital of 20 crore. State owned banks will have 49% stake and the remaining will be the with the private sector lenders. Yes? So what will be the correct answer? IDRCL is responsible for issuing security receipts. So all of the above will be true. IDRCL was incorporated in 2021. The authorized capital, paid up capital is given correctly. State-owned banks own 49%. When we are talking about NARCL, the bad bank, National Asset Reconstruction Company Limited. It has the authorized capital of 2,750 crore, paid up capital of 1,409 crore, right? Public sector banks in case of NARCL have 51% stock and the remaining is with the private sector entity. So the correct answer will, we are talking about IDRCL, we are not talking about NARCL. Security receipt, qualified institutional buyers. SR are the tradable instruments issued by the ARC and QIB means the qualified institutional buyers. Okay? They can be banks, insurance companies, institutions, qualified institutional buyers. Retail investors are not allowed to participate in the security market, in the security receipt that are issued by the ARC. Okay? QIBs are institutional investors. They have significant financial knowledge, right? They are sophisticated investors. They require less regulatory protection than regular retail investors. So, retail investors, individual investors like us, we cannot invest in the security receipt issued by ARC. All right? Okay. Next. A financial advisor uses the Maslow's framework to guide client conservations. For a 28-year-old freelancer, she recommends building an emergency corpus, buying health insurance, starting a systematic investment plan for long term goals, joining a professional network for peer lending. You need to evaluate the following statements. The advisor's recommendation spans physiological safety and social needs. SIPs reflect self actualization and are premature for this client. Professional networking aligns with the social and esteem needs. Maslow's model supports simultaneous pursuit of the multiple needs. So, what is Maslow's hierarchy? The pyramid that we had revised yesterday. There are 5 levels of needs that every individual goes through, starting with the basic level needs, which are the physiological needs. Then we have the safety needs, social needs like love and belongingness needs, esteem needs, and self actualization need. Every person moves up the ladder of the need once the lower level needs are fulfilled, right? And we match it to the individual's demand of banking products and services as well. So, in the physiological level needs, we have the basic things like a savings account or a very basic loan. Okay, in the safety needs, we would have some insurance products or maybe an FD. In the social needs, we would have insurance products for self and family. Esteem needs, maybe a credit card that offers special benefits. And when we are talking about self actualization, that would mean that highest potential retirement plans, pension plan. So, what will be correct? First statement, advisors recommend physiological safety and social needs. First statement will be correct. First statement will be correct. Second statement, SIP does not reflect self actualization. If you're having a systematic investment plan, it is for your safety and growth, not self actualization. Self actualization would mean if you are able to have portfolio management services or wealth management services. SIP is simple. In multiple deposits, you want to create the investment. Okay, so second statement is incorrect. Third statement, professional networking aligns with social and esteem needs. Correct. Third statement is true. Fourth statement says Maslow's model supports simultaneous pursuits of multiple needs, not strictly linear. This is correct. Okay? One can have multiple needs at one time, but if lower level needs have not been fulfilled, then you cannot move above over the higher level needs. You can pursue physiological and safety needs together. Or maybe you want to have a family, but you also want to increase your wealth. Then it means that you are overlapping your needs. Okay, so the fourth statement will also be correct. The correct answer will be option B. Yes, the option B. 1, 3, and 4. Only the second statement is incorrect. Okay, only the second statement is incorrect. 1, 3, and 4 is correct. Hmm. Next. Also, when we were discussing about the banking products and services, so we saw insurance products in the physiological needs also, in the safety needs also. If insurance product with tagged cover is there, it was there in the esteem needs also. So overlapping products are there, overlapping. It is not a strict demarcation that this product will be in this particular need only, in this particular stage only. So it has overlapping motivation. Next. A nationalized bank conducts a service audit across its urban branches. The audit reveals the following. Branch interiors are clean but outdated, with faded signage and worn out furniture. Staff are courteous and knowledgeable, but often delay in resolving the customer complaints. Customer report that while promises are made, follow ups are inconsistent. The bank has recently introduced a chatbot that provides instant responses, but it lacks empathy. Now we are talking about the customer expectations. We are talking about the customer expectations, right? Customer has expectations about reliability of the product, tangibility of the product. They also want the empathy, understanding, responsiveness. So let us go through the statement one by one. The bank scores low on tangibles due to poor upkeep of the physical infrastructure. Correct. Why? Because faded signage, worn out furniture, outdated interior. First statement true. The staff's behavior reflects assurance but low responsiveness. Yes, they have knowledge but they're not responding to it. They are delaying in resolving the customer complaint. So, second statement is also true. The chatbot enhances empathy. No. The chatbot lacks empathy. It is only giving mechanical answers. Mechanical answers. So, third statement is incorrect. Reliability is compromised due to inconsistent follow up. Correct. When we are talking about follow ups, that is the meaning of reliability. Ability to perform the promised service dependably and accurately. When the officer says that the amount will be sanctioned in 2 days, does he follow up and inform the status or not? That is the meaning of reliability. And it is compromised. So the correct answer will be option A, 1, 2, and 4. Right? 1, 2, and 4. Third statement is incorrect. Right? Empathy requires human understanding, not just speed. Next question. A bank's flagship co-branded credit card has been in the market for 7 years. Initially, it saw rapid adoption due to exclusive airline tie-ups and cashback offers. However, recent data shows stagnant customer acquisition, declining usage frequency, and rising customer attrition. Customer attrition means the customer is leaving the bank, they're switching the bank. The product team is considering a redesign. So, what will be correct? Which of the following? No, you need to select the incorrect statement. So, we are talking about the product life cycle, which has the stages of introduction, growth, maturity, decline, and death. Okay, so the product is likely in the saturation stage of product life cycle. Introducing new features and repositioning the card can help extend the maturity phase. The decline in usage and customer indifference are indicators of the introduction stage. Without intervention, the product may enter the decline stage, leading to revenue erosion. You need to select the incorrect statement, not the correct statement. Incorrect. Incorrect statement. Only one of the statements are incorrect. So here we are seeing that initially it saw rapid adoption. So it has already crossed the growth stage. The introduction stage and growth stage has already crossed, right? Now we are seeing stagnant customer acquisition, declining usage frequency. This means that we have entered into the saturation phase. All right. And if we do not correct it, then it will lead to product decline. So the third statement is incorrect, right? Stagnation and indifference means saturation. So first statement is correct. Introducing new features. The bank tries to keep the product for longest in the maturity phase. How will they do it? By introducing new features, repositioning the card. Now we are seeing decline. This means it is in the maturity stage. In the introduction stage, the sales volume is low, but the reason is low customer awareness. Low customer awareness. And if we do not reinvent the product, then it would lead to decline stage and death stage. So the correct answer is option C. Third statement is incorrect. I hope you remember the product life cycle, the features of the product life cycle. What happens in the introduction stage, the growth stage, maturity stage, and the decline stage. Clear? Why statement 3 is incorrect? Is it clear or not? Yes, statement 3 is incorrect. You had to select the third statement. In your exam, don't be in a hurry. If you think that some question is complicated, it is lengthy, mark it for review. And once you have gone through all the 100 questions, come back for these questions. Do not waste your time in lengthy, complicated questions. Solve the easy ones first. All right, solve the easy ones first. Okay, so the correct answer, option C. A credit information company is evaluating a borrower's profile. The borrower has one defaulted auto loan, timely payments on two credit cards for last 12 months, five inquiries in the last 2 months, a credit mix of personal loan, credit card, and home loan. You need to answer which of these behavior, how the behaviors are going to impact the score of the customer, the credit score of the customer. The past default will negatively impact the score, though its effect may reduce over time. Timely payments on credit cards will improve the score through positive payment history. Multiple recent inquiries may lower the score due to perceived credit hunger. A diverse credit mix will reduce the score due to complexity in risk management or risk assessment. When we are talking about credit scoring, what are the positive signs of a credit score? What is a credit score? It is the credit worthiness of a person, which is calculated on their past behavior. How many credit products have been availed? What are the features of the credit products? How many of them are due? These things are considered. So, what will be the correct answer? Payment default negatively impact the score. Timely payment improve the score. Multiple recent inquiry lower the score. But a diverse credit mix will increase the score. Having only unsecured loans or credit cards will reduce the score of the customer, right? Of the person. Having a good credit mix that includes secured and unsecured loans will increase the score. So the correct answer will be option A, 1, 2, and 3 only. Yes, option A, 1, 2, and 3 is correct. As per the RBI stipulations, banks must offer uniform interest rate on savings bank deposit. Banks have been given autonomy. RBI no longer fixes the interest rate on savings deposit, but banks can offer differential rate of interest over a specific amount only. Before that, uniform interest rate has to be paid. What is that limit? Up to rupees 50,000 only on all savings deposit without exception, only to senior citizens and minors, up to rupees 1 lakh irrespective of the deposit size within this limit. Yes, the correct answer will be option D. So up to 1 lakh rupees, uniform interest rate has to be followed. Beyond that, beyond that, differential rate of interest can be given, but the bank will not discriminate in the matter of interest paid on such deposits between two deposits of similar amount accepted on the same day at any of its offices. All right. So differential rate of interest can be offered beyond 1 lakh, but between two accounts that are same, between two deposits that are similar. Bank cannot discriminate between them. So the correct answer is 1 lakh for uniform interest rate on savings bank deposit. Consider the following statements regarding the term deposit tenor. Banks may accept term deposits for a maximum of 120 months. Deposits over 12 months should ideally be accepted in multiples of 3 months. Deposits for periods like 13 months or 38 months and 12 days may be accepted on consumer request. Deposits exceeding 10 years are strictly prohibited under all circumstances. So, what is the minimum and maximum tenor for a fixed deposit? For a fixed deposit, when we are talking about the minimum tenor, if the deposit is more than 15 lakhs, 15 lakhs and above, then 7 days. Amount less than 15 lakhs, 15 days. Maximum can be 120 months. If it is more than 12 months, then it should be in multiple of 3. However, on specific request of the customer, deposits can be given for any period, even if it is not in multiples of 3, like 13 months, 37 months, whatever. In special cases, in special cases, or like in the order of the court, or where the interest of a minor is involved, then banks can also open account for a period of more than 10 years, but then it should not be more than 20 years. So normally it is maximum 10 years. On request or specific orders, more than 10 years can also be given. So yes, the correct answer will be option A, 1, 2 and 3 only. Statement 4 is incorrect. Deposits can be given for more than 10 years only on special circumstances. That is why the fourth statement will be incorrect. Next. In an either or survivor time deposit, when both account holders are alive, premature withdrawal requires. When the fixed deposit is opened on the either or survivor instruction and all the account holders are alive, joint account holders, all the account holders are alive. Consent of one account holder only, we are talking about premature withdrawal. Consent of the bank manager only. Consent of all account holders. Consent of the nominee is required. So this we are talking about the operational issues in case of joint FD in name of two or more persons, either or survivor, when all account holders are alive. On maturity, all of the account holder, any of the account holder can take the payment. But in case of premature payment, consent of all account holders is essential. Second case, when any of the account holder has expired. On maturity, any of the surviving account holders can take the payment. But on premature withdrawal, the consent of the legal heirs and the surviving account holders is essential. So the correct answer will be option C. Both the account holders are alive. Premature withdrawal requires consent of all the account holders. Right? If one of the account holder dies, then in the case of premature withdrawal, consent of the surviving account holders and the legal heirs of the deceased is required. Regarding repayment of time deposits under Income Tax Act norms, evaluate. The 20,000 rupees threshold applies to deposits held across all branches of the bank. Interest already paid is excluded from the 20,000 threshold calculation. Repayment above 20,000 must be via account pay instrument or account credit. Joint deposits are excluded from this threshold. So, mode of repayment of time deposit. What will be correct? 1, 2 and 3 only, 2 and 3 only, 1 and 4 only, or all of the above? Everyone answer this question. Everyone who has newly joined the session, kindly like the video and participate. Try to answer the question. What will be the correct answer? So, in this scenario, in terms of the Income Tax Act as amended, when the aggregate amount of all deposits repayable after notice or repayable after a period, held by a person singly or jointly with others at a branch of the bank, not the bank as a whole, together with interest is to be paid is 20,000 or more. Then the repayment should be made by the means of account payee, banker's check draft, or by crediting the account of such depositor. All right. So the correct answer should be option C, 1 and 4, right? Second statement, interest already paid will be excluded. Okay. And the joint deposits are excluded. Wait, the 20,000 threshold applies to deposit held across all branches of the bank. See, when we are talking about the accounts, it is a single person jointly or jointly with others at a branch of the bank, not the bank as a whole. So we will not be taking into account across all the branches of the bank. Incorrect. Incorrect. Right? Then what else? Repayment above 20,000 must be paid via account pay instrument or account credit. Third statement is obviously correct. Joint deposits are not excluded from the threshold calculation. It is to be included. So the second and third statement should be correct. Second and third statement. Right? Second and third statement should be correct. Okay. Hmm. Consider the following statements regarding loans against fixed deposit. Each FD is treated as a separate contract and has its own fixed deposit receipt. Fixed deposit receipt must be surrendered at the time of repayment of the loan. Banks may freely grant loans against third party FDRs at concessional rates. If the borrower defaults, the FD is adjusted against the loan on maturity. So what will be correct? What is loans against fixed deposit? To help the customers tide over their temporary requirement of funds, banks they offer loan against FD up to 80 to 90% of the value of the FD. But the margin varies from bank to bank. Moreover, the interest which is charged will be higher than what the bank is paying on the FD. And then original FDR should be kept so that it cannot be utilized again and again, and FDRs of the bank in which the FD is there. Advances against other bank time deposit is not allowed as per RBI guidelines. Okay, so what will be correct? Each FD is treated as a separate contract and has its own FDR. Yes, consolidated amount will not be taken into consideration. FDR must be surrendered at the time of repayment of the loan. Banks may freely grant loans against third party FDRs. Incorrect. If the borrower defaults, the FD is adjusted against the loan on maturity. Correct answer will be option A, 1, 2, and 4. 1, 2, and 4 only will be correct. Third statement is incorrect. Alright, 1, 2, and 4 will be correct. Yes. Other limits, what are the other limits? In case advances against recurring deposits, facility will be allowed only if the account has been in existence for at least 1 year. Advances against fixed deposits solely in the name of minor should not be considered. Declaration should be taken that in a proper format should be obtained in addition to the usual security documents. Any advance is strictly prohibited against time deposit of other banks. Other banks. Next. Consider the following statements about auto sweep facility. Now we are talking about the two-in-one account. We have studied yesterday on maturity or at the time of default. Both. If the customer fails to repay the loan along with the interest until the maturity of the fixed deposit, margin will be retained so that the bank can recover it. And on maturity, the fixed deposit will be adjusted. against the loan, and if there is any balance left, then it will be paid to the customer. Both. All right. The customer need not pay. Whatever is there in the fixed deposit, that will be used to repay the full loan, the principal and the interest. It will be set off in a manner, it will be set off, cancelled out. All right. Okay. Now about the two-in-one facility. Auto sweep requires manual intervention by the customer. The FD created earns interest applicable on the day of the sweep. The sweep amount must be in multiples of 1000 or as per the bank's rule. If transfers excess balance of savings bank account or current account to the FD automatically. So it is a sort of combination of savings bank account and fixed deposit, which offers both liquidity and higher rate of interest also. So there are two facilities, auto sweep and reverse sweep facility, right? Auto sweep and reverse sweep facility. If in the savings deposit amount goes above the predetermined limit which has been fixed, it will be automatically swept to the FD and it will earn the higher rate of interest. If let's say the amount goes below the prescribed limit in the savings bank to honor any obligation, then the last in first out in multiples of 1000 will be broken and it will be transferred to the savings bank account. It will be transferred to the savings bank account. So auto sweep facility requires manual intervention by the customer. No, it is automatically done. FD created earns interest applicable on the day of the sweep. Yes. Then the sweep amount must be in multiple of 1000 or as per the bank's rule. Correct. It transfers the excess balance from the account to the FD. So that is the auto sweep facility. Auto sweep facility. Right? Excess amount in this running account is transferred in multiples to the of 1000 to the FD. That is the auto sweep. Reverse sweep means any amount which is shortfall is now swept to the savings account from the FD, right? So that will offer maximum liquidity. The customer can use it for their regular obligation. So the correct answer should be 2, 3 and 4, right? Option C. Has anyone answered option C? Pretty yes. The option C will be correct. 2, 3 and 4. It does not require manual intervention by the customer. It is automatically transferred. Automatically. Right? The FD form through the auto sweep facility carry the rate of interest as applicable to the fixed deposit and other relevant terms applicable on the day of auto sweep. So the correct answer is C, 2, 3 and 4. Now here's a case study. Mr. Rakesh, a salaried employee with a gross monthly income of 60,000 rupees, applies for a loan to purchase a new car worth rupees 8 lakhs. The bank calculates EMI such that his net take home pay remains 27,000. He requests a 7-year repayment tenor. Confused with second point. This one. The FD created earns interest applicable on the day of the sweep. This one. Whatever interest is applicable on the FD, it is paid on the transferred amount as well. It is paid on the transferred amount as well. FDR is surrendered at the time of loan sanction and returned to the customer on payment. It gets dissolved, right? Once the payment is completed, on maturity it gets completed, not on payment, on maturity of the FD, on maturity of the loan, it is set off against each other. All right. What is the confusion? In which question? Do you want me to explain the loan against FD? So basically, it allows you to secure funds without breaking the deposit. You can retain the interest earnings while accessing the liquidity. The interest rate is 2% above the FD rate, right? And it avoids premature withdrawal penalties as well. Loan is typically 75 to 95 or 70 to 90% of the FD principal value. Okay, what else? Your original FD continues to earn interest, reducing the net interest cost of the loan. The loan amount it keeps get reducing. Okay, so that is the loan against FD. Loan against FD. Okay, let us take it at the end. These are the things that you need to remember about the fixed deposit account. Go through the PDF of yesterday's session once if you are facing any doubt. If you are having any confusion, go through the PDF. Whatever is written there is correct. You have already attended the capsule batches also, right? You have the PDF of the capsule batch. That also you can go through if you have any confusion. Okay, do not worry about it. So this question, what would be correct? This person has a gross monthly income of 60,000, applying for a car loan of 8 lakhs. The car is of worth 8 lakhs. The EMI says that the net home take pay remains only 27,000 and he's requesting a 7-year repayment tenure. When we are talking about the loan, then the net take home pay, when we are deciding the net take home pay, it should not be less than 40% of the gross green salary or income of the applicant. Normally, not less than 40%. For high income applicants, it can be 15%. If we are talking about auto or vehicle loans, then also the gross gain salary point has to be considered. 40 to 50% of the gross income should remain after the EMI loan has been calculated. So, is it fulfilling the criteria or not? Does it fulfill the criteria or not? Is the net home pay within 40 to 50% range or not? Yes, it is, right? So the loan will be eligible because the net home pay is within the 40 to 50% range. All right, it is within the 40 to 50% range. So it will be eligible. It will be eligible. And for a new car loan, for four wheelers, banks do allow repayment up to 7 years. For two wheelers, 5 to 6 years. For second hand vehicles, 3 years is allowed. So that will also be fine. So it is eligible. All right. Question 64, option 2. You were confused about the option 2. FDR must be surrendered at the time of repayment of the loan so that the customer cannot take the loan again on it. So that the customer cannot avail a loan again on it. Multiple loans should be avoided. For that very reason, the fixed deposit receipt has to be surrendered with the bank. All right? All right, clear. The receipt FDR has to be surrendered to the bank at the point of sure. Let us go to question number 64. The second point says that the FDR must be surrendered at the time of repayment of the loan. This statement is correct. It's not wrong. It's not wrong. The statement is correct. Bank issues a separate receipt for each fixed deposit. Because each deposit is treated as a distinct contract, this receipt is known as the FDR, which has to be surrendered to the bank at the time of repayment of the loan. Statement is correct. All right, it is correct. There's nothing wrong with the statement. All right. So 1, 2, and 4. I told you the correct answer was 1, 2, and 4. No, I've understood what you're asking, but at the time of repayment, very clearly it is mentioned in your books. Receipt has to be surrendered to the bank at the time of repayment. It has to be surrendered at the bank to the bank at the time of repayment. Okay? Go through the notes. It is clearly mentioned in your notes. Nothing out of the notes, all right? Everything is given. How do we decide 40 to 50%? Calculate 40 or 50% of the income that is given. It was given 60,000 rupees as the income. 50% would be 30,000 rupees. Calculate 40% of 60,000, you'll get the limit. Simply 40%. 40% of 60,000 is 24,000, and the net take home pay has been given as 27,000. 24K, yes, and it has been given 27,000. If the borrower defaults in FD, must be adjusted on default, but not on maturity. Why not on maturity? See, when the FD matures, let's say the loan amount was of 5 lakh rupees and the FD is of 6 lakh rupees. The bank will retain the 5 lakh rupees as the loan repayment, and remaining 1 lakh will be returned to the deposit holder. All right. If the borrower defaults, then also if the borrower pays fine, it is it is adjusted on maturity. Whatever is the loan default, whatever is the loan amount. See, do not get confused, do not get stuck on a particular topic. You can revise it later on, okay? You can revise it later on. If you have confusion in any topic, you have the notes, do not waste your time. We have a lot many questions still remaining that we need to do. We are continuing to the next question. How do RLPCs contribute to the final stages of the loan process? Loan process. When we are talking about the processing of retail loans, there are two options. First, we have a stand-alone loan process, and then we have the centralized process. In the stand-alone process, at the branch level, everything is done. In the centralized process, there are the retail hubs which perform various functions. The branches, they bring the loan application to the retail hubs, and then sanction of the loan, disbursement, appraisal, everything is done at the RLPC. Here you are being asked in the final stage of the loan process. How do RLPCs contribute to the final stage of the loan process? Advising on the loan sanction to the borrower or branch, executing the loan related documents and completing the mortgage formalities, releasing the loan funds to the borrower, independently sourcing new business opportunities. What will be correct? So, the starting phase would be to conduct the marketing process, tell the customers about the product, getting the customer onboarding, doing the preliminary documentation. But now we are talking about the loan advising, execution of the document, and releasing to the fund. Sourcing the new business, sourcing the new business is related to, sourcing the new business is related to the earlier stages. So the correct answer will be option A, 1, 2, and 3. The correct option will be option A, 1, 2, and 3. Fourth statement is incorrect. All right? Do, wait a minute. If you want, I can share the book with you. Hmm. You're getting confused at the last point for no reason at all. For no reason at all. Look here. Clearly this says the FDR is to be surrendered to the bank at the time of repayment. This is your Macmillan book. Do not believe what Google is saying. Trust what your book says. Trust what you have studied in the classes and the notes. Fixed deposit receipt has to be surrendered to the bank at the time of repayment. Can you see this? Is it visible? The FDR has to be surrendered to the bank at the time of repayment. Look. All right, confusion cleared now. FDR has to be surrendered to the bank at the time of repayment. Done. We are not discussing this topic again. Let us move on. Clear. Okay. Yes, so the correct answer here is option A. Moving on to the next question. In a bond, the issuer is obligated to, in a bond, the issuer is obligated to pay interest only if profits are earned, repay principal only if bond is traded, pay periodic interest and repay principal at maturity, convert the bond into equity at any time. What is a bond? Now we are starting with the questions from the module D. Module B complete. We are starting with the questions from module D. What is a bond? It is a traditional product where we can invest. It is a fixed income instrument derived from a loan forwarded by an investor to the borrower. And the issuer promises to pay a specific interest for the life of the bond, right? And the principal amount or the face value at maturity to the investor. So, what will be the correct answer? What is the issuer obligated to do? Pay the interest only if profits are earned, or only the principal or periodic interest and the principal, or to convert the bond? Yes, the correct answer will be option C. The issuer is obligated to pay the periodic interest and repay the principal on maturity. Not B. Not B. Correct answer is C. It is a fixed income instrument derived from a loan forwarded by investor to a borrower. The issuer promises to pay specific interest for the life of the bond and the principal amount or the face value at maturity to the investor. Correct answer option C. Consider the following statements about convertible bonds. Which of the following are correct? Convertible bonds pay periodic interest at predetermined intervals. Regular convertible bonds give the investor an obligation to convert. Mandatory convertible bonds offer higher interest rates than regular ones. Reverse convertible bonds give conversion rights to the issuer. What is the meaning of a convertible bond? That on maturity, it will be converted into the shares of the issuing entity, issuing company. That is the meaning of convertible bond. There are three types of convertible bond: regular convertible bond, mandatory convertible bond, and reverse convertible bond. Regular convertible bond pay periodic interest at predetermined intervals. True. This statement is correct. Answer. First give your answers and then we will discuss statement wise. What will be correct? 1, 3 and 4, 2 and 4, 1, 2 and 3, or option D, all of the four statements. What will be correct? In the regular convertible bond, the investor gets the right to convert the bond into shares of the issuer on maturity. If they want, they can do it. In the mandatory convertible bond, there's an obligation. They have to get it converted. In the reverse convertible bond, the issuer has the conversion rights. Okay, so the correct answer will be option A, 1, 3, and 4. Second statement is incorrect. Regular convertible bond gives the investor only the right, merely the right. And because in mandatory convertible bond, there's an obligation, no option given to the investor. That is why it offers a higher rate of interest than the regular convertible bond. So the correct answer is option A. Definition of the types of bonds are given here. Regarding the municipal bonds, revenue bonds are repaid from project specific revenues. General obligation bonds are backed by the municipality's overall revenue. Revenue bonds typically offer lower returns than the government obligated bonds. Sorry, general obligation bonds. Municipal bonds in India have a maturity of up to 30 years. Now, when we are talking about bonds issued by municipal bodies, they can be general obligation or revenue obligation on behalf of the municipal corporations, right? They have a maturity period that can amount to 3 years. In the general obligation bond, the bond generate finance for various projects in general, and the repayments are also made from the general revenues of the municipality. In the revenue bond, they focus on generating funds for specified projects, and the repayment interest given to the bondholders explicitly is generated via the projects declared in the bond only. Revenue bonds have an extended period of up to 30 years, higher than the general obligation bond. All right. So the correct answer, what should be the correct answer? First statement is correct. Second statement is also correct. Third statement is not correct. Third statement will not be true. Fourth statement is correct. So the correct answer will be option C, 1, 2, and 4. Option C, 1, 2, and 4. Correct. Next, evaluate the following statements about the inflation indexed bonds. These bonds are typically issued to the institutional investors. Returns are indexed to the CPI or WPI. Both principal and interest earned adjust with inflation. These bonds are ideal for hedging against purchasing power erosion. Which of these statements are correct about the inflation indexed bond? What will be the correct answer? Inflation indexed bond. So the principal and the interest earned both will be in accordance with inflation. Ordinarily, however, they are not issued to institutional investors, they are issued to retail investors. Retail investors. So the first statement will be incorrect. Returns are indexed to CPI or WPI, the consumer price index or the wholesale price index. Correct. Both principal and interest. And yes, these bonds are ideal for hedging against purchasing power erosion. Why? Because when inflation rises, the interest being paid will also be adjusted. So the correct answer becomes option D, 2, 3, and 4. 2, 3, and 4. All right, 2, 3, and 4. Clear? Yes, D is the correct answer. Absolutely true. Regarding the Equity Linked Savings Schemes Fund, ELSS funds. ELSS funds are eligible for tax deduction under Section 80C. ELSS have a lock-in period of 3 years. ELSS funds invest exclusively in debt instruments. ELSS returns are tax-free under Section 10, subsection 38. What will be correct? Equity linked savings scheme. Investments, these are basically tax saving schemes only. Investments made are exempted from income tax under Section 80C. First statement, correct. They have a lock-in period of 3 years. Second statement also correct. Right? Third statement and fourth statement will be incorrect. Yes, Sudesh, correct. The correct answer will be option A, 1 and 2 only. They do not invest exclusively in debt instrument. That would be known as a mutual fund, maybe a debt mutual fund, debt oriented mutual fund. And they are tax free under the Section 80C, not Section 10. Correct answer, option A. Which of the following clients is most likely to engage in investment manager rather than an investment banker? So we have studied the difference between investment management and investment banking, right? Investment management, when a client has surplus fund, they want to increase their income, they want to increase their returns. So they will approach an investment manager. Investment bankers are approached by those clients who are in a situation of deficit. They want to raise capital. They want to raise capital through public issue, IPO, underwriting, mergers and acquisition, advisory. So, which of the following client is most likely to engage an investment manager rather than an investment banker? Read it clearly, carefully. Naveen, you're answering B. Read it carefully. Which of the client is likely to engage an investment manager rather than an investment banker? The correct answer will be option C, a person who is seeking long term portfolio growth. Startup raising venture capital, IPO, or the government issuing sovereign bonds. That would be by the investment banker. All right? Yes, Sudesh, correct. The correct answer is option C. Remember, investment bankers are known as market makers. They act as intermediaries between the issuers of the bond and the investors on the buy side and the sell side, right? They help a company go public or equity research, portfolio allocation. All right? So the correct answer will be C. Next. In an all or none undertaking, which of the following outcomes is most accurate if the full issue is not sold? Now, when we are talking about underwriting arrangements, it can be of three types, right? Underwriting arrangements are of three types. Firm commitment is there. First is firm commitment. Second is all or none. And third is best effort. Best effort. Okay. So we are asking about the all or none undertaking. The underwriter retains the unsold portion and pays the issuer. The issuer receives partial proceeds based on sold shares. The deal is cancelled and the issuer receives no proceeds. The underwriter adjusts the price to clear the issue. This is what we make mistake. Do not be in a hurry. See, right now, obviously, we have limited time. We need to complete the all the five modules, but tomorrow you need to solve just 100 questions. Trust me, 2 hours are enough to solve 100 questions. The questions will be easy. Okay. Hmm. So when we are talking about all or none, yes, the correct answer will be option C. Infirm commitment. Infirm commitment. What is the meaning? The underwriter, first of all, buys the entire issue, right? And they try to sell it. In the firm commitment, it would mean that if anything remains unsold, the underwriter will hold all the responsibility, will bear the financial burden. In the best effort, anything remains unsold is returned to the issuer. In the all or none, however, if anything remains unsold, the deal is called off and the issuing company, the issuer entity receive nothing. All right. In the all or none, if the entire issue cannot be sold at the offering price, the deal is called off and the company receives nothing. Next. Evaluate the following statements about discretionary and non discretionary portfolio management services. Discretionary portfolio management is ideal for clients who prefer to delegate investment decisions. Non discretionary portfolio management requires the manager to act within a pre approved IPS. Discretionary portfolio management typically commands a higher fee due to active involvement. Non discretionary portfolio management allows the manager to override client instructions in volatile market. Now there are four types of portfolio management services. Active and passive relate to the index. When the manager mimics whatever the index is doing, that is passive. When they are outbeating the index, taking different position, that is passive, right? In the discretionary portfolio management, the manager is given the complete control for the portfolio and the account. They can take whatever decision they want. Non discretionary portfolio management services, however, the manager acts only on the advisory role. They only advise, and the final decision is taken by the client. Whether or not to go with the advice, whether or not to buy or not, is with the client. So, in the portfolio management, which is discretionary, highest involvement is there. That is why the manager will also seek a higher fee, right? So, discretionary portfolio management is ideal for the client who prefer to delegate investment decision. Non-discretionary, the manager has to act within the pre-approved IPS. Discretionary requires a higher fee. Non-discretionary allows the manager to override. No, the fourth statement will be incorrect. Correct answer will be 1, 2, and 3. All right, 1, 2, and 3. Clear, everyone? Option A. Option A. The definition of active portfolio, passive portfolio, discretionary, and non discretionary is given. You can go through it. Which of the following exit load structures is compliant with the SBI's portfolio management services guidelines? Exit load means now they do not want to continue. So, what will be correct? 4% exit load in first year, 2% in second year, 1% in third year, 3% in year 1, 2% in year 2, 1% in year 3, 2% in year 1, 1% in year 2, 1% in year 3, or 3% for all. So, what will be the correct answer? The correct answer will be option B. And beyond 3 years, no exit load is applicable. All right. Other than this, no upfront fees will be charged. The operational fees cannot be more than 0.5%. Maximum exit load of 3% to be charged in the first year, 2% in second year, 1% in third year. Clients have to be onboarded directly. CA will certify the minimum specified net worth of the portfolio managers of rupees 5 crores. So the correct answer will be option B. Which of the following correctly distinguishes direct tax from indirect tax? Direct tax is levied on goods, indirect tax on income. Direct tax is transferable, indirect tax is non transferable. Direct tax is paid by the taxpayer. Indirect tax can be shifted to another party. Direct tax is collected by the state governments only. Very simple question. Easily you can answer. Yes, the correct answer is option C. Direct tax, like which is the tax on income and profession. Okay, it cannot be shifted. The burden and incidence fall on the same person. Indirect tax, like the GST, is there, which can be shifted to another person. The incidence and the burden falls on different person. Evaluate the following statements regarding the financial year and the assessment year. Financial year is also referred to as the previous year for tax purposes. Assessment year is the year in which income is earned. Income tax returns are filed in the assessment year. Both financial year and assessment year run from April 1 to March 31. What will be the correct answer? So, financial year or previous year is the year in which we earn the income, and assessment year is the year in which we pay the taxes. Okay? Why these are kept separate? Because we cannot be taxed on the income that we have not yet earned. So the first statement is correct. Assessment year is the year in which the income is earned is incorrect. Third statement is correct and the fourth statement is also true. Correct answer option A. Option A, yes. Correct answer option A, 1, 3 and 4. Miss Kapoor, a person of Indian origin, leaves India for employment abroad. She earns 20 lakhs in India and stays for 185 days during the financial year 2022-23. She was a resident in one out of the last 10 years and stayed 600 days in the last 7 years. What is the residential classification for the assessment year 2023-24? What will be the residential status of Miss Kapoor in the assessment year for filing the taxes in 2023-24? So let us recall. The when will be a person known as a resident Indian? If in the previous financial year the stay is 182 days or more, and they are also doing their profession, earning their income in India, right? Or other than this, what is the second classification? Second classification, stay in India for the immediately preceding 4 years, 7 years, it is 365 days or more, and 60 days or more in the relevant financial year. Okay, is this being fulfilled? She is earning their income in India and staying for 185 days during the financial year 2020 to 23. Okay, but now she has left India for employment abroad. What will be the classification of this person? What will be the classification? Just a second, there's some issue here. Wait. Hmm. Yes. So the correct answer will be option C, correct. Resident, not ordinarily resident. This person will be classified as a resident, not ordinarily resident. They are a resident, but they do not fulfill the ordinary resident criteria, which is 2 out of 10 years in the immediately previous year, or stay in India for at least 730 days in the 7 immediately preceding years. So this person qualifies the resident criteria, but not ordinary resident. Not ordinary resident. Correct answer option C. Great. Which of the following conditions must be satisfied for an individual to be classified as a resident, ordinarily resident? Resident in 2 out of last 5 years and 365 days in the last 3 years. Resident in 2 out of last 10 years and 730 days stay in the last 7 years. Resident in 5 out of last 10 years and 182 days stay in the current year. Resident in 3 out of last 7 years and 500 days stay in the last 5 years. So resident, ordinary resident, 2 out of 10 years in the immediately previous years, and stay in India for at least 730 days in the immediately previous 7 years. So the correct answer will be option B. Option B will be correct. So if such a case study is given to you in the exam, the institute gives you that such and such person is there, their stay in India was this much, then they left for such purpose, you will be able to classify and identify whether the person is a resident, non-resident, ordinary resident, or not ordinary resident. Next, which of the following deductions is available under section 24 of the income tax? Deductions allowed under section 24 of the Income Tax Act: principal repayment of home loan, interest paid on home loan, stamp duty on property purchase, or rent paid for residential accommodation. Yes, very easy. Section 24B, section 24B, interest paid on the home loan. Principal repayment will come under section 80C, or the first time home loan buyers, that is also a separate section. So the correct answer, section 24B, is about the interest paid on home loan. Again, I'm repeating that you can download the RBWM summary PDF. It is already on the Oliveboard app. Okay, it is already on the Oliveboard app. And after this class, I will also upload this PDF so that you can download it, you can save it. Although you do not need this PDF now, but do download the summary PDF. It will help you revise. If you have any confusion left, that PDF would be enough. Okay. Consider the following statements about tax saving options under section 80D. Deduction up to 25,000 is allowed for self and family below 60 years. Additional 25,000 rupees is allowed for parents below 60 years. Deduction up to 50,000 is allowed for senior citizens. Medical expenditure for uninsured senior citizens is not deductible. What will be the correct answer? Specifically about section 80D. Specifically about section 80D. What will be correct? What will be correct? So, option A, everyone is saying option A. Yes, so when we are talking about section 80D, medical insurance premium can be claimed at 50,000 rupees, 25,000 for self and dependent family that comprises of spouse and children, and additionally 25,000 for dependent parents below 60 years of age. One can also claim medical insurance premium if paid up to a maximum of 1 lakh per annum if availed for the senior citizens. If the senior citizens are not covered under any health insurance, then the medical expenditure incurred can be claimed under Section 80D for 50,000 rupees. That is why the fourth statement is incorrect. Correct answer is option A, 1, 2, and 3 only. 1, 2, and 3 only will be correct. Alright, 1, 2, and 3. Miss Mehta took an education loan for her MBA and paid 1.2 lakh rupees interest during the year. She also paid 2 lakh rupees interest on her home loan and 1 lakh towards principal repayment. Which deductions can she claim and under which sections? 2 lakhs under section 24, 1.5 lakh under section 80C, 1.2 lakh under section 80E, 1.2 lakh under section 80E only, 2 lakhs under section 80C and 1.2 under section 80E, 2 lakhs under section 24 only. What will be the correct answer? So all of these sections, they work independently, right? Section 24B is for the interest paid on a home loan. So 2 lakh was the interest paid. She can claim the deduction. 80C are the various schemes which are included, products which are included under 80C. One of the product is also principal repayment of the home loan. So that can also be claimed, and education loan can also be claimed. Interest paid on the education loan can also be claimed. So the correct answer will be option A. All of these claims are allowed to be made. All of these claims are allowed to be made. Next. Mr. Sharma inherited a house property from his father in April 2020. His father had purchased the property in January 2010. Mr. Sharma sold the property in August 2023. What will be the nature of capital gain and its tax treatment? So the property was inherited in 2020. When a property is inherited, it is not considered as a capital gain. But Mr. Sharma has also sold the property in 2023. So the year of consideration or the year of transfer will become 2023. What will be the year of acquisition? So it is a short-term capital gain taxed at slab rate, long-term capital gain eligible for indexation benefit, no capital gain as it was inherited, or long-term capital gain taxed at 30% flat rate. The correct answer will be option B. It is a long-term capital gain. When we are talking about the property which was inherited, we take into consideration the period of time at which the original buyer had also purchased the property. All right, the original buyer had also purchased the property. So from 2020, so obviously it is a long term capital gain and it will become eligible for indexation. How do you calculate the indexation benefit? You multiply the cost of acquisition with the year of transfer divided by the year of acquisition, CII, right? The cost inflation index. Mr. Verma bought a commercial property in January 2022 and sold it in May 2023. What is the nature of capital gain? Long-term capital gain, exempt income, not taxable, or short-term capital gain. What is the nature of the capital gain? What is the nature of the capital gain? What will be correct? It will be a short-term capital gain, correct. Commercial property, the period should be 24 months. But here for the long-term capital gain, here it is held for less than 24 months and sold off. That is why it is a short term capital gain, right? For certain asset classes, it is 12 months, but not for a commercial property. Mr. Singh sold a land for 80 lakh rupees. The index cost of acquisition is 50 lakh rupees. Transfer expenses of 2 lakhs, cost of improvement of 5 lakh, and CII has been adjusted to 8 lakh rupees. What is the long term capital gain? So you need to calculate it using the indexation long term capital gain formula, right? So what will be correct? How do we calculate the capital gain? From the consideration cost, from the cost of consideration, you subtract the cost of acquisition, right? And you also subtract the transfer expenses. So what will be the correct answer? To calculate the long term capital gain from the consideration, that is 80 lakhs, we will minus 50 lakhs, we will also minus 2 lakhs. Cost of improvement is adjusted to 8 lakh. Already CII has been used and the index cost of improvement is given to you. So you will minus another 8 lakh rupees, not 5 lakh rupees, but 8 lakh rupees. So what will be the correct answer? The correct answer will be option A, 20 lakh. If in the question CII adjusters was not given, then the institute would have given you the cost inflation index of the year, right? The cost inflation index of the year. And then you'd have to calculate using the formula. Correct answer option A. Cost of improvement is given at 10 lakh rupees for the financial year 2012-13. Cost inflation index of the year is 200. Cost inflation index of the financial year 2025-26 is given as 348. You need to calculate the index cost of improvement. I want all of you to solve the question and answer it. Everyone, calculate the index cost of improvement. I'm giving you 20 seconds. Calculate the index cost of improvement. What will be the index cost of improvement? Hmm. So revise the formula. Calculating the index cost of improvement. Multiply the cost of improvement with the CII of the year of transfer divided by the CII of the year of improvement. This is how we calculate the index cost of improvement, right? Correct. So 10 lakh, 10 lakh multiplied by the CII of the year of transfer, which is 2025-26, 348, divided by the CII of the year of improvement, which is given as 200. So the correct answer will come out to be 17.4 lakh. Is everyone getting 17.4 lakh? Option A, 17.4 lakh. Option A will be correct. Option A, right? Option A will be correct. Okay. Remember the formula. Similarly, if you want to calculate the index cost of acquisition, so multiply the cost of acquisition with the CII of the year of transfer divided by the CII of the year of acquisition where you acquired the property, and that will give you the index cost of acquisition. Okay. Mr. Gupta sold a residential house in June 2025 for 1.8 crore rupees. He had purchased the house in May 2010 for 60 lakhs. He reinvested 1.2 crore in two residential properties within the prescribed time. Which exemption applies and by how much long term capital gain is taxable? So, residential property is sold and the proceeds are utilized to purchase another residential house property, two residential house property. So this will be covered under which section? Section 54F, long term capital gain partially exempt. Section 54, partially exempt. Section 54 EC, 50 lakh rupees exempt, or section 54 long term capital gain fully exempt. Why partially exempt? Why are you saying option B? What's the reason for it? Long term capital gain is completely exempt in case of sale of a house property by investing in up to two house properties, right? Here, obviously, the capital gain should not be more than 2 crore. Correct? So, the correct answer will be option D, section 54, and it will be fully tax exempt. Fully tax exempt. Correct. The correct answer will be option D. Mr. Arora sold inherited house property in April 2025. The property was originally purchased by his father in 1998. He sold it for 1.5 crore and invested 1 crore in constructing a new house completed in March 2028. Which exemption applies and is it valid? Which exemption applies and is the exemption valid or not? So, an inherited house property has been sold. When the house property is inherited, it is not a transfer, it is not a capital gain. But if it is later on sold out, then it becomes a capital gain. Then it becomes a capital gain. Okay? So, what will be correct? Everyone. Option A, section 54, valid as the construction is completed within 3 years. Section 54F, valid as sale consideration is reinvested. Section 54 EC, invalid due to late investment, or no exemption as the property was inherited. So again we are talking about section 54. New house has been constructed and is it completed within 3 years? Sold in 2025 and completed before completion of 3 years. So the correct answer will be option A, section 54. When we are talking about section 54F, it is exemption on capital gains on sale of any asset other than a house property. 54 EC, sale of house property on reinvesting in specific bonds issued by the National Highway Authority of India or the Rural Electrification Corporation. So the correct answer will be option A. Which of the following statements is true regarding the closed ended mutual funds? They can be redeemed anytime at the NAV from the AMC. They are not listed on any exchange. They have a maturity and trade at the market price. They are only available to institutional investors. What will be the correct answer? True regarding the closed ended mutual fund. Closed-ended mutual fund have a lock-in period, a maturity period before which it cannot be redeemed. Open-ended mutual fund, they can be redeemed at any time. So here the correct answer will be option C. Correct. They have a fixed maturity and trade at market prices. They have to be listed. They are listed on the stock exchange and they are available to retail individual investors as well, not just to institutional investors. So the correct answer is option C. Which of the following is not a mandatory eligibility criteria for a bank to set up a subsidiary for insurance broking? When the bank is participating in the insurance business, they can do it either departmentally, this would be without risk participation, just acting as the broker, or the bank can set up a joint venture or a subsidiary investment, prescribed capital including capital conservation buffer. You need to mark the incorrect one, not a mandatory capital. So, when the bank is setting up a subsidiary or a joint venture to participate in the insurance business with risk participation, then they need to keep a minimum net worth of 1000 crore before investment, and after investment it should not be less than 500 crore. Okay. However, here the question says they're setting up a joint venture for insurance broking without risk participation. So the minimum net worth of 1000 crore criteria is removed. Just that after investment, it should not be less than 500 crore. Okay, not less than 500 crore. Other things are correct. Net NPA should not be exceeding 3%, net profit in the preceding 3 financial year, and the prescribed capital buffer has to be maintained. If the bank is taking the insurance business departmentally, then no requirement is there, just that the deposit will be kept. A deposit will be kept with another scheduled bank, and IRDAI will have a lien over it. Okay, so keep this thing in mind. Insurance business with risk participation through a subsidiary or joint venture, net worth of 1000 crore, and it should not be less than 500 crore after investing in the subsidiary. Minimum prescribed capital, net non-performing asset not more than 3%, net profit in the preceding 3 financial year. Broking business through the subsidiary or joint venture, every other thing is required except the 1000 capital requirement, 1000 crore net worth requirement. After investment, the net worth should not be less than 500 crore. Insurance broking services departmentally, IRDAI license is required, and banks have to keep a non-refundable deposit of 50 lakh rupees, right? 50 lakh rupees to be maintained with a scheduled commercial bank other than itself, on which IRDAI will have a lien, right? So the correct answer will be option C. Consider the following statements regarding the insurance business with the risk participation. The bank must have a net profit in at least two of the last 3 financial years. The bank must retain a minimum net worth of 500 crore after investing in the subsidiary. The bank's net NPA level must not exceed 3%. The performance of the existing subsidiaries must be satisfactory. So, this we have already discussed. First statement, what will be the correct answer, everyone? With risk participation, it has made a net profit in the preceding 3 financial years. Preceding 3 financial years. So the first statement will be incorrect. Second, third, and fourth statement will be correct. So the correct answer will be option B. B, not C. Option B, 2, 3, and 4, right? Retain a net worth of 500 crore after investing in the subsidiary. B will be correct. Regarding the departmental insurance broking, which of the statement is incorrect? Select the incorrect statement. The bank must maintain a 50 lakh deposit with IRDAI lien at a different scheduled commercial bank. A board approved policy must cover customer suitability and grievance redressal. The bank must obtain a license from IRDA and pay a non refundable deposit. The bank must maintain a deposit with itself if it is a scheduled commercial bank. This also we have already discussed, right? You need to answer the incorrect statement. So the incorrect statement will be which option? 1, 2, 3, or 4. Which will be incorrect? When they are participating in the broking service departmentally, then they need to get license from IRDAI and deposit a non-refundable deposit of 50 lakh, and on it IRDAI will have a lien. So the correct answer will be option D. This deposit has to be maintained with a commercial bank other than its own, with a scheduled commercial bank other than its own. Next, which of the following statements is true regarding the ownership patterns in the demat account? A single demat account can hold securities in both individual and joint names. Ownership pattern of demat account need not match the physical certificates. Separate demat accounts must be opened for each distinct ownership pattern. Joint demat account can be opened on either or survivor basis. What will be the correct answer? Which of the following statement is correct? You need to answer the correct statement. Question 120. Answer. What will be the answer for question 120? Dematerialization means converting the physical certificate, physical securities into the electronic form. There are two depositories, NSDL, CDSL. Depository participants are bank. As the owners, we are known as the demat account holder, the beneficiary account holder. Joint demat account cannot be opened on either or survivor basis. The ownership pattern has to match the physical certificate. The correct answer is option C. Separate demat account must be opened for each distinct ownership pattern. And you cannot also change the ownership pattern. If you do that, you'll have to close the old account, open a new one. However, definitely the possibility is there, option is there. You can close the old account, transfer all your demat securities into a new one with the same DP or with a new DP as well, right? The demat account should be opened in the same ownership. If you have two share certificate, one in your individual name, another jointly, then you will have to open two different accounts in respective ownership pattern. No investor can open a demat account on either or survivor basis. It is not possible to make changes in the names of the account holder of a beneficial owner account. A new account has to be opened. All right. No one answered option C. Correct answer is option C. Okay. When a bank undertakes factoring through a subsidiary, the total equity investment in such entities must not exceed 10% of the bank's total assets, 5% of the bank's net worth, 15% of the bank's Tier 1 capital, or 20% of the bank's paid up capital and reserves. What will be the correct answer? When the bank is undertaking factoring business through a subsidiary, what is required? If they are doing it departmentally, then it can be with recourse, without recourse, a proper board approved limit should be there. However, factoring services shall be provided on the through a subsidiary, then the factoring company shall not exceed 10% of the bank's paid up capital and reserves. 10% of the bank's paid up capital and reserves. Correct answer is option D. Yes. 10% of the bank's paid up capital and reserves. It cannot be more than that. The bank's investment in the subsidiary cannot be more than 10% of the bank's paid up capital and reserves. Under the without recourse factoring, exposure is booked on. Now, options are there. with recourse, without recourse, and partial recourse is also there. The exposure will be on whom? In the without recourse factoring. On the assigner, on the debtor, the bank itself, or the factoring company. So the exposure will be reckoned on the assigner for factoring on a without recourse basis. Without recourse basis on the assigner itself. Okay. The exposure will be reckoned on the debtor for factoring on, sorry, reverse. The exposure will be reckoned on the assigner on factoring with recourse basis. So if it is with recourse, then the exposure will be on the assigner, right? Without recourse basis, it will be on the debtor. It will be on the debtor. And if it is a partial recourse basis, limited recourse basis, then it will depend upon the terms and conditions of the agreement, right? So the question is asking you about without recourse basis, it will be on the debtor. The correct answer will be option B, on the debtor. All right. Without recourse basis, it will be on the debtor. With recourse basis, it will be on the assigner. Which of the following is not included in the annual subscription ceiling for the sovereign gold bonds? Sovereign gold bonds. Bonds purchased in secondary market, bonds subscribed in multiple tranches, bonds held as collateral by banks, or bonds held jointly with another eligible investor. When we are determining the annual subscription limit, which of the following is not taken into consideration? Which of the following? No. See, do not get confused. Exposure is reckoned on the assigner on with recourse basis. Exposure is reckoned on the debtor on without recourse basis. And in the limited recourse basis, it will be divided as per the terms of agreement. What will be the correct answer here to this question? Question number 123. Which of the following is not included in the annual subscription ceiling of the sovereign gold bond? Now, when we are talking about the sovereign gold bond, there are limits up to which we can invest, right? 4 kg for individuals, 4 kg for HUF, 20 kg for trusts and similar entities. In case of joint holding, the limit applies to the first applicant. Annual ceiling will include bonds subscribed under different tranches during the initial issuance by government, those purchased in the secondary market. However, the annual ceiling will not include bonds subscribed under which are kept as collateral by the banks and other financial institutions. The bonds that you have kept as collateral with the banks or financial institution will not be included in the annual subscription limit. But annual subscription limit will include bonds subscribed under different tranches, those purchased from the secondary market, right? Annual ceiling will include bonds subscribed under different tranches during initial issuance of the government. Ceiling on investment will not include the holdings as collateral by banks and other financial institutions. No, not A. Bonds purchased in the secondary market will be included in the annual subscription series. Limit. Annual subscription means limit. What is the limit up to which you can invest in a sovereign gold bond? Limit. That is the subscription ceiling. Ceiling is the limit. Regarding the sovereign gold bond operational features, consider the following statements. Which of them are correct? Sovereign gold bonds eliminate risks and costs associated with physical gold storage. Sovereign gold bonds are held in RBI's books or in demat form. Sovereign gold bonds are subject to making charges and purity concern. sovereign gold bond may incur capital loss if the gold price falls. Which of the following are correct regarding the features of the sovereign gold bond? Regarding the features of the sovereign gold bond. These are government securities denominated in grams of gold, substitutes for holding physical gold. So the investors will pay the issue price in cash and the bonds will be redeemed in cash on maturity. The quantity of gold remains protected because the investor is going to receive the ongoing market price. So it is a superior alternative to holding gold in the physical form. So eliminates the risk. They are held in the demat form. However, they are not subject to making charges and purity concern. But the sovereign gold bond may incur capital loss if the gold price falls because the interest rate is fixed 2.5% per annum on the amount of initial investment. All right? Yes, so the correct answer is A. Which of the following individuals is ineligible to enroll in the Atal Pension Yojana? A 25-year-old salaried individual with no statutory pension coverage, a 38-year-old homemaker with savings bank account, a 42-year-old self-employed shopkeeper with no income tax liability, a 30-year-old student with a savings account. Which of the following is ineligible to enroll in the Atal Pension Yojana? Yes, a 42-year-old self-employed shopkeeper that they do not have any income tax liability is ineligible. Other than that, 18 to 40 years is eligible. Here, the age is given 42. That is why they will become ineligible. All the others, they fall within the limit 18 to 40 years. So the correct answer is option C. Consider the following statements about India gold coins. The India gold coins are minted using gold source exclusively from domestic mobilization schemes. IGCs are issued by RBI and carry sovereign guarantee on return. IGCs are part of the broader Make in India initiative. IGCs are issued in dematerialized form only. What is India gold coins? India gold coins. So these are brought to the public under the government's vision of Make in India. Under the gold monetization scheme, the coins are of 24 carat purity, triple nine fitness, assuring consumers of absolute purity. It is one of the purest forms of gold available in the country, minted in India by MMTC. Right? It comes with the Ashok Chakra. So, what will be the correct answer? Which of these statements are true? The correct answer, first statement is true, but they do not offer sovereign guarantee on return. So, second statement is not true. IGC are part of the Make in India initiative. IGCs are issued in dematerialized form. No. IGCs are coins, they are proper coins, physical gold. Sovereign gold bonds are dematerialized form. All right. So the correct answer, fourth statement is incorrect. Fourth statement is incorrect. Okay. Yes. Option A, 1 and 3 only. The transition. Okay. So with this, we have completed module B and module D. And I can see many of you are not answering the questions correctly. If you are having confusion in any topic, do revise the. I have uploaded it, right? The yesterday session PDF. Use it for your revision in the topics. Module B and Module D is very important. Together, they will hold more than 50% weightage in the paper. Remaining 50% weightage will be from your module C, A, and E. Okay? Okay, let us take a break. We can take a break and then we will continue with the remaining questions. Remaining questions won't take a lot of time. They won't take a lot of time. All right? So let us take a break and then we will return. 5 minutes. Only 5 minutes. All right. So let us continue now. Let us continue. Hmm. So what will be the answer to this question? Question number 127. The transition from mass retail banking to class retail banking involves shifting focus from individuals to corporates, offering standardized products to all customers, targeting high net worth individuals with customized services, or reducing the customer base to improve operational efficiency. No. The correct answer will be targeting high net worth individuals with customized services. In the mass retail banking stage, retail banks are offering generic products, standard products to the mass market, all of the customers. They want to get a stable source of income. From this customer base, now they will select the profitable, high net worth individuals, and they will be offered customized, tailor made services. So the correct answer will be option C. A mid-sized scheduled commercial bank has recently launched a retail banking campaign targeting salaried professionals in tier 2 cities. The bank offers bundle products including savings account, personal loans, credit cards, and third party insurance. The campaign emphasizes standardized offerings with uniform and minimal customization. Over time, the bank plans to introduce wealth management services for select clients with investable surplus exceeding 50 lakh rupees. So, what is the strategy that the bank is following? Currently in class retail banking, transitioning towards universal banking. Currently in mass retail banking, transitioning towards private banking. Currently in wholesale banking, transitioning towards retail asset securitization, or currently in para banking, transitioning towards liability side. So yes, currently the bank is in mass retail banking stage, and they are transitioning towards class retail or private banking. Correct answer option B. Option B. Which public sector banks were among the earliest to enter the credit card business in India? Public sector banks: Punjab National Bank and Canara Bank, Bank of India and Indian Bank, Union Bank of India and UCO Bank, or the Bank of Baroda and Andhra Bank. Which public sector banks were the early players? Correct answer option D. Right? Option D. A mid-sized private bank has launched a retail strategy focused on digital first delivery. It offers mobile banking, email support, web based onboarding. The bank uses analytics to segment customers and tailor products. However, it faces challenges in differentiating basic offerings and maintaining cost efficiency. Which of the following strategic imperatives should the bank prioritize? What should be the strategy of the bank to improve their situation? They want digital first delivery, but they are facing challenges in offering the basic products and maintaining cost efficiency. Expand physical branches to improve customer reach, invest in channel innovation and operational efficiency, shift focus to wholesale banking for better margins, or standardize all products. Yes, the correct answer is option B. Option B. Okay. To improve cost efficiency, they can shift the low value transaction to the cost effective channels. Right? Option B. A fintech startup collaborates with a regulated bank to offer savings account, microloans, and credit tracking tools via a mobile app. The startup uses the bank's infrastructure but controls customer interface and product design. Which of the following statement does not correctly describe this model? No, this question is not important. We can skip it. Hmm. Next. Now, this is important from the module A, very important. In the context of retail banking models, which approach treats retail banking as a part of the bank's overall business strategy without distinct structural separation? Departmental approach, strategic business unit approach, functional outsourcing model, or the integrated approach. Retail banking is treated as part of the bank's overall business strategy. Separate focus is not given to retail banking. What will be the correct answer? What will be the correct answer? When there is no segmentation, then we are following the integrated approach, having a unified business without structural separation. Unified business. How are you answering SBU? In the SBU, the separate profit centers are set up. Separate profit centers are set up. Independent profit centers, they control all the operations. In the departmental approach, the division is done on the basis of various departments: accounting team, financing team, marketing team. But here the retail banking model says retail banking is a part of the bank's overall business strategy without any structural separation. There is no structural separation at all. So the correct answer will be option D. It is an integrated approach. A top um, One of the top 5 public sector bank headquartered in Mumbai restructures its retail banking operations into autonomous divisions focused on home loans, credit cards, personal banking. Each division operates as a profit center and independent targets performance metrics. The bank retains the option to discontinue any unit that fails to meet the strategic objective. Which retail banking model is the bank implementing? Autonomous division, profit center, independent target. Look at the keywords. It is the strategic business unit approach. Yes. Separate independent unit has been set up for its retail banking operations. It is the SBU approach. A foreign bank operating in India has segmented its retail banking into SBUs for wealth management, retail lending, and digital banking. Each unit has its own leadership, budget, performance KPI, key performance index. The bank uses this structure to rapidly adapt to market changes and discontinue the underperforming verticals. What are we talking about? Which of the following statement? Obviously, we are talking about the SBU approach. It reflects a modular strategy aligned with management by objective. Yes. It is not a departmental model. Incorrect. It enables strategic flexibility and targeted profit tracking. It is consistent with the SBU approach. So the correct answer will be option B, 1, 3, and 4. 1, 3, and 4. 1 is also correct, right? 1 is also correct. 2 is incorrect. If you're answering option C, how can you say it has central oversight departmental approach plus it is giving strategic flexibility and targeted profit tracking? In the SBU approach, separate profit centers are set up. Separate profit centers are set up. They have their own goal, product, pricing, strategy, everything. Okay? They are independent of each other. For retail banking, the division will focus on retail banking only. No one is going to interfere. It works with management by objective. Okay, do not get confused. In the departmental model, SBUs are not set up, profit centers are not set up. Different departments are there. Which of the following are limitations of the departmental approach in retail banking? lack of focused strategy for retail banking growth, difficulty in modular restructuring based on performance, limited autonomy in decision making for retail units, high cost of compliance due to decentralized operations. Which of the following will be the features or limitation of departmental approach? So, in the departmental approach, separately, any focus is not given to retail banking by setting up SBU, but different departments are set up. Different departments are set up. So, the first statement will be correct, right? It lacks a focus strategy for retail banking growth, which is there in the SBU approach. Second statement is also correct. Why? Because it would not be possible to restructure the model based on performance. Based on performance, if we are able to restructure, it is the SBU approach. And there is limited autonomy in decision making. But there is not decentralized operation, centralized operation is there, and high cost of compliance will not be there. The correct option will be A, 1, 2, and 3. 1, 2, and 3. Option A, 1, 2, and 3 will be correct. Okay, which question is important? Okay, now answer this. We have answered question on SBU and departmental as well. Answer this question. Which of the following best distinguishes the SBU approach from the departmental approach in retail banking? SBU approach integrates retail banking into the overall business plan. Departmental approach isolates it as a standalone vertical. SBU approach treats retail banking as a modular profit center with autonomous control, while departmental approach embeds it within functional division like finance or marketing. SBU is typically adopted by public sector bank. Departmental approach is preferred by foreign banks. SBU approach eliminates the needs for performance tracking, while departmental approach mandates independent profitability metrics. Yes, finally. Correct answer is option B. So now the difference between SBU and departmental approach is clear. Now the meaning of SBU approach and departmental approach is clear to everyone. Okay, correct answer is option B. Which of the following best describes the retail banking model implementation in most of the public sector banks? End-to-end sourcing, predominant outsourcing, in-house sourcing, or balanced mix of outsourcing and in-house. For the public sector banks, mostly public sector bank. Is it possible that you all are tired now? That is why you are getting confused. Is that possible? Okay. So, yes, the implementation model followed by public sector bank is the in-house sourcing. New generation private banks, they go with mostly outsourcing, right? Foreign banks also outsource it. Old generation private banks, they have a balanced mix. Which process model is characterized by modular structural offering end-to-end solution product wise? Do not be in a hurry to answer this. Take your time. All right. Remember the scale that we have studied. The horizontal model, vertical model, predominantly horizontal and predominantly vertical. You need to answer end to end solution product wise. End to end solution product wise. Is it vertically organized, horizontally organized, predominantly vertical, or predominantly horizontal? No, it is not the vertically organized model. Naveen, no. Option C is incorrect. When we are talking about these models, it depends upon a central common customer database which can be used across product. If it is available, why are you answering predominantly vertical model? When there's a centralized customer database which is available across the product, it is customer centric, then it is the vertical model or the predominantly vertical model. Yes, the correct answer is B, horizontal. In the horizontal model, product wise, end to end solution is given product wise. There is no common customer database. It is not used across product. B. If most of the products are product oriented, then predominantly horizontal. Some customer database can be available, predominantly horizontal. If mostly for most of the product a central database is there, for some product end to end solution is provided, then predominantly vertical. Clear now? Everyone? Everyone who has answered C, is it clear now? Correct answer is option B. Product wise end to end solution is in horizontally organized model. In the vertically organized model, a common central database is there. Okay, I will explain it again. So remember, there are four types of models: horizontal model, vertical model, predominantly horizontal, and predominantly vertical. It depends upon whether end to end solution is given product wise or there is a common customer database which is used across product. If there is a common customer database used across product, it is a vertical model and it is also known as customer centric. But if there is no common customer database and end to end solution is provided product wise, then it is horizontal model. Remember the features, remember the key terms associated with it. End to end product wise, horizontal. Common customer database across product. Customer oriented, vertical. Product oriented, horizontal. Customer oriented, vertical. If let's say the bank is offering 10 products, for all the 10 products a common customer database is there, it is vertical model. If end to end solution is provided for all the 10 products separately, horizontal. Out of 10, if 8 are provided product wise, predominantly horizontal. If 8 are provided customer centric with a common database used across product, predominantly vertical. All right. So all 10 products end to end solution, horizontal. All 10 products customer centric, vertical. Out of 10, 8 products end to end solution is available, only 2 common customer database, predominantly horizontal. Out of 10, only 2 are product centric, remaining are having a common customer database used across product, predominantly vertical. Now do not forget this concept. Definitely question will be asked. Which of the following statements correctly describe the vertically organized model? Again, take your time, answer it correctly. Right now we have I explain it again. What is the vertically organized model? Take your time and then answer it. It uses a centralized customer database across product. It is modular and product specific. It enables cross product functionality. It lacks customer data orientation. Vertical model. You need to answer according to the vertical model. Vertical model. What will be correct about the vertical model? Option C, 1 and 3. Okay, others also? Others also. Naveen, answer it. Preeti, Richin, everyone answer it. What will be the correct answer? Option C, okay. So look at the key terms. Central customer database across product, feature of the vertical model. Okay. Product specific, feature of the horizontal model. Cross product functionality, that is, across products the data can be used. Again, vertical. Statement 4 says it lacks customer data orientation. No, we have a common customer database, complete customer data orientation. 1 and 4 is not an option. The correct answer is option C, 1 and 3. 1 and 3. All right. Okay. A Tamil Nadu based old private sector bank has adopted a retail banking process model that blends predominantly horizontal and vertically organized structure. The bank has relatively high levels of common customer information across product. The strategy aligns with objective aggressive bank. Now look at the key terms. A blend of predominantly horizontal, predominant and vertical model. Blend is being used. High level of common customer information. That is, it is predominantly vertical, right? Not completely vertical, but predominantly vertical. For most of the products, high level of common customer information is there, and they are having the objective of aggressive banking growth. So what will be correct? The bank is using end-to-end sourcing for all retail functions. Outsourcing. The bank's model supports cross-selling and upselling. The bank lacks a centralized customer data, or the bank. So option D and option C is obviously incorrect. Option C says that it lacks central customer data, but the theory says the common customer information is there across product. D says it is horizontal model, again incorrect. Yes, so the correct answer is option B. The bank is supporting cross-selling and upselling. It is a predominantly vertical model. Finally, yes, very good. Okay, the correct answer is B. In terms of risk distribution, which statement is most accurate? If we talk about the difference between retail banking and corporate banking, so which statement is correct about risk distribution? Retail banking has widespread risk due to large customer base. Retail banking has concentrated risk due to high ticket size. Corporate banking has widespread risk due to large customer base. Or option D, corporate banking has low risk due to diversified clientele. Yes, the correct answer is A. Risk is well diversified in retail banking and it is concentrated in corporate banking. Okay. A bank is evaluating its portfolio performance. It observes that its retail segment has a large number of small ticket loan with relatively stable fund, while the corporate segment has fewer clients but higher exposure per account. The bank also notes that the NPAs in the corporate segment have a more significant impact on its balance sheet. Based on the case, which of the following conclusions is most accurate? Retail banking has higher NPA impact due to volume. Corporate banking has lower risk due to fewer client. Retail banking yields lower returns due to narrow spread. Corporate NPAs affect the bank more due to high ticket size. So the case study tells you that the corporate is facing significant impact of NPA on the balance sheet, and the reason is of the high ticket size, more quantum of loan. Correct answer option D. Regarding the profit and profitability, which of the following are true? A company can be profitable without earning profit. Profitability is a measure of success relative to the business size. The profit is always a better indicator than profitability. Profitability enables holistic performance evaluation. So we have studied about the difference. Profit is an absolute term, profitability is a relative term. Profit simply means total revenue minus total expenditure. Profitability talks about the efficiency, how well the organization is performing in relation to the cost. Yes, so the correct answer will be option B, 2 and 4. To get profitability, profit is important. Every organization's main goal is to make profit. It will be profitable if they are able to generate more profit out of the expenses. And the correct answer, profit is not always a better indicator. Sometimes the institute may be making profit, but at the cost of lower efficiency. All right. Okay, now here are some numerical questions. Some numerical questions. Okay. A company B reports 2 crore rupees in sales, 1 crore 20 lakh in cost of goods sold, 40 lakh in operating expenses, 10 lakh in interest, and 10 lakh in taxes. An analysis is evaluating its efficiency and financial health. Based on the case, which of the following conclusion is most accurate? So calculate all the levels of profit one by one. Gross profit, operating profit, net profit. Also calculate the operating profit margin and net profit margin. What is gross profit? Total sales minus cost of goods sold. Right? What is operating profit? Operating profit? It is gross profit minus the SG and A, or the operating expenses. Operating expenses. What is net profit? Operating profit minus taxes plus interest. What is, how's the margin calculated? Divide the operating profit by the total sales, or the net profit by the total sales. Now tell me, calculate and tell me what will be the correct answer. What will be the correct answer? Use your calculators, answer it. So the gross profit is coming out to be 80 lakhs. Okay, let us write it down together. Gross profit is coming out to be 80 lakh. To calculate gross profit margin, divide 80 lakh by the total sales, that is 2 crore. Divided, we are getting 4 into 100, 40%. So first option is correct, right? First option is correct. Gross profit margin is coming out to be 40%. Is it true? First is correct. Operating profit is not 80 lakh, gross profit is 80 lakh. So the operating profit would be 40 lakh. 80 lakh minus 40 lakh, right? Then net profit. Net profit is equal to 40 lakhs minus 20. It is not 40 lakhs, it is 20 lakhs. Net profit margin. Calculate net profit margin divided by the total sales. It is coming out to be 10%. So both A and D, right? Both A and D is correct. Operating profit is also correct. Operating profit margin is also correct. And the net profit margin is also correct, right? Both A and D. Both A and D are correct. But the operating profit and the net profit is incorrect. Both A and D. All right. Next. What is the correct formula for calculating the net interest margin? What is the correct formula for calculating the net interest margin? Net interest income divided by total liabilities, net interest income divided by the bank capital, net interest income divided by the average total cost, or the net interest income divided by net profit. Very simple question. Yes, the correct answer is option C. Net interest income divided by the average total cost. Okay. Now, how do you calculate the total net interest income? Net interest income. It is interest received on assets minus interest paid on liability. Net interest margin. Why do we use the average total asset, which is, by the way, total assets at the start of the fiscal year plus the total assets at the end of the fiscal year divided by 2. So we calculate the net interest margin using this formula. Regarding the net interest income and the interest rate spread, which of the following are true? Net interest income is equal to interest earned on assets minus interest paid on liabilities. Net interest spread is equal to average rate paid on liabilities minus the average rate earned on assets. Net interest margin is a key indicator of future profitability. And statement 4 says net interest income includes earnings from loans and securities. What will be the correct answer? Right. So the second statement is incorrect. When we are talking about the net interest income and interest rate spread, so net interest income is equal to average interest earned on asset minus the average paid on liability, not the opposite. So correct answer should be option B, 1, 3 and 4. All right. It is, how do we calculate it? Simply average interest earned on asset minus the average interest paid on liability. Opposite is given, reverse is given. So the correct answer is B. Identify the incorrect statements regarding the accounting structure of a bank. Assets is equal to liabilities plus bank capital. Loans and securities are considered bank asset. CRR earns interest at market rates from RBI. Bank capital is part of the owner's equity. So what are the assets of the bank? That generate income for the bank. That generate interest for the bank. That is the assets of the bank. So obviously it is going to include the loans and securities. Liabilities. Why liability? Because the liabilities are used by the bank to create more assets. So this is also true. Bank capital is part of owner's equity, but we all know CRR earns no interest from RBI. CRR balances earn no interest from RBI. There is the negative carry on CRR balances. On SLR, the bank can earn because it includes the investment, securities. But CRR, zero interest. Okay. Which of the following best explains why bank owners prefer using liabilities over capital to fund asset purchases? Liabilities are tax exempt. Liabilities increase return on equity through leverage. Liabilities reduce the regulatory burden, or the liabilities are not recorded on the balance sheet. Why do banks use more liability? Yes, because they are using leverage, right? If they create more deposit, they'll be able to give out more loan. But if they use their own capital, and even if there is a loss of 1 or 2% in their total liability, it would lead to wiping out of the capital. So that is why they increase their return on equity through leverage. All right. Another numerical. Bank Y reports 100 crore in net income, 5,000 crore in average total assets, and 500 crore in bank capital. The bank's owners are evaluating the return on equity performance and considering increasing leverage to enhance the returns. Based on the case, what is the bank's return on equity? So remember, what is the formula to calculate the return on equity? First you answer it and then we will solve it together. How do you calculate the return on equity? So okay, already you have given the answer. Return on equity is very simple. It is the net income divided by the bank capital, right? Net income is given as 100 crore and bank capital is given as 500 crore. So this will come out to be 0.2 or 20%. 20%, right? The formula to calculate return on equity, it is net income divided by the bank capital. Another way is to use the ROA multiplied by the leverage ratio, but it is a very long um, formula. If, however, in the question the bank capital had not been given, or maybe the net income had not been given, then you had to use first, you had to calculate the ROA. Correct answer option C. Ravi Enterprises manufactures modular furniture. For financial year 2024-25, they have reported revenue from operations at 15 lakh rupees, cost of raw material and direct labor at 9 lakh, factory rent and utilities at 1 lakh 20,000, sales team salaries 80,000, interest on business loan 50,000 and income tax at 30,000. Everyone who's present here, if you are new to the session, make sure that you like the video. We'll carry on for half an hour more, maximum half an hour more, and then we will wind up the session. All right, simple questions are left. Answer this now. You need to calculate the net profit. So first you'll calculate the gross profit. 15 lakh minus 9 lakh will give you 6 lakhs, right? 6 lakhs. Okay. Calculate the operating expenses. Now, operating expenses will include the rent and utility and the salary. So, 1 lakh 20,000 plus 80,000, 2 lakh. Operating expenses is 2 lakh. Operating profit will become 6 lakhs minus 2 lakhs, giving us 4 lakh. Net profit will be 4 lakh minus um 50 plus 30, 80, right? So 3 lakh and 20,000. 3.2 lakh will be the correct answer. Option A will be the correct answer. Yes, A will be correct. So like I told you, if you remember the formula, you will be easily able to answer these questions. And this was definitely a 2-mark question. Nimbus Retail LLP has the following figures: net sales, cost of goods sold, operating expenses, depreciation, which is included in operating expenses. What will be the correct answer? You need to calculate the operating profit margin. So first calculate gross profit, net sales minus cost of goods sold. 40 minus 25 is 15. Okay, 15. From this, first we'll calculate the operating profit. 15 minus the operating expenses. It is written depreciation is included in the operating expenses. So we will simply subtract 10 out of it. 10. Okay, and we are left with 5. To calculate operating profit margin, divide 5 by the total sales, that is 40. So what will be the correct answer, everyone? What will be the correct answer? Divided by total 400000. 0.125 multiplied by 100, 12.5%. Yes, the correct answer will be option A, 12.5%. 12.5%. Very good. Zenith Textiles Limited has net profit, total assets, and equity. Net profits, total asset, and equity has been given to you. You need to calculate the ROA and leverage ratio. How do we calculate the ROA? If you remember the formula of ROA, it is simply net income divided by the average total asset, right? So, how do you calculate the net income? Net profit, net income, they mean the same thing. So 30 divided by 2 crores into 100, that would be 15. 15%, ROA will be 15%. And how do you calculate the leverage ratio? Formula for leverage ratio: bank assets divided by the bank capital. Okay, bank assets divided by the bank capital. So equity is bank capital. Yes, the correct answer will be option D. ROA is 15%, leverage ratio is 4. So just remember the formula and apply it. ROA formula, you divide the net income by the average total asset, right? Let me write it down. Net income divided by the average total asset. And the leverage ratio formula is simply bank asset divided by the bank capital. D. Helix Pharma reported net profit after tax 15 lakhs, total assets at 1 crore 50 lakh, equity of 50 lakh, and debt of 1 crore. What is the ROA, ROE, and the leverage? Calculate it one by one. Use the formula for ROA. You tell me now. I'm telling you the formula because we have already written it down. So, net income divided by the average total asset. That is ROA. ROE. What is the formula for ROE? It is, correct. So, it is net income divided by the bank capital. ROE is net income divided by the bank capital. And leverage ratio is what? Leverage ratio? It is bank asset divided by the bank capital. Tell me, what will be the correct answer? What will be the correct answer? So 15 lakh divided by 1 crore 50 lakh into 100 will give us 10%. ROA will be 10%. ROE, again, net income is 15 divided by 50 into 100. Calculate it, use it. What will be the correct answer? 50, 0.3 into 100. ROA will come out to be 30%. ROE will come out to be 30%. And leverage ratio 50, 1.5, right? 1.5 divided by 50 is giving 0.3. Yes, so the correct answer will be option A. Yes, the correct answer is option A. All right, option A is correct. ROA 10%, ROE 30%, leverage ratio 3. Delta Motors has an ROA of 8% and leverage ratio of 2.5%. Its ROE is reported at 20%. And analyst suspects aggressive debt financing. Which of the following best explains the relationship among these? ROE is equal to ROA divided by leverage ratio. ROE is independent of leverage ratio. ROE is equal to ROA plus leverage ratio. Or ROE is equal to ROA multiplied by leverage ratio. Correct. The correct option is D. So, ROA is net income divided by the bank asset, and leverage ratio is the bank asset divided by the bank capital. Bank asset cancelled out. We are left with net income divided by the bank capital, which is the ROE, right? So the correct answer is option D. So I think these numericals you can easily answer now, right? You can easily solve these numericals now. Very simple. Hmm. Which of the following components reduce the effective earning capacity of a bank's asset base, thereby impacting ROA? What would reduce the bank's earning capacity? Cash held in vaults, ATMs, currency chests, CRR maintained by RBI, SLR investment in government securities, loan loss reserves maintained for NBA. When will the bank's earning capacity reduce? if they are able to give out less loan, if they are able to give out less loan, if they are able to create less assets, right? So higher CRR maintained with RBI and loan loss reserves maintained for NPA will lead to reducing of the bank's asset base. So 2 and 4 should be correct. SLR investment will increase the interest earning of the bank, and cash held, if they have more cash held in um wait, so 1 3 and reduce the capacity, 1 2 and 4 should be correct, right? 1 2 and 4, 1 2 and 4 should be correct. SLR investment will increase their earning capacity. Cash held in vaults, CRR maintained with RBI, loan loss reserve will reduce it. So 1 2 and 4 will be correct. 1 2 and 4, 1 2 and 4. Okay. Which of the following statements correctly explain ROE, ROA? We have already done. Okay, this also. Yes, now let us start with the questions from Module E. All right, Module E. Which professional body grants membership to practicing valuers in India? Indian Institute of Architects, Institution of Engineers, Institution of Valuers Delhi, or the Council of Technical Valuers. Membership, not license, but membership. License they need to secure as per the Income Tax Act, Wealth Tax. Membership they will get from the Institution of Valuers Delhi. Consider the following statements about registration and recognition of valuers. Registration under the Wealth Tax Act is granted on the basis of background and experience. Banks and financial institutions may require fellowship of the institution of valuers. Valuers are classified under a single unified category. Membership is mandatory for all practicing valuers. What will be the correct answer regarding this? Regarding the registration and recognition. See, registration under the wealth tax is mandatory, which is granted on the basis of technical background and experience. So the first statement is correct, right? And they also require, may require. See, option 2 and option 4 are contradictory of each other. Option second statement is saying they may require fellowship. Fourth statement is saying it is mandatory. So out of these two, only one can be correct. Elimination method can be used here. We will eliminate the statement 4. 1 and 2 will be correct, and there's not a unified category. There are different kinds of valuers. Valuers for immovable property, movable property, valuers for urban land or rural land, agricultural land, specialized building. Different categories are there. So correct answer is option A, 1 and 2. In the income capitalization method, the value of agricultural land is determined by multiplying the gross income by the market rate of land, deducting the expenses from rental income, and applying a depreciation factor, capitalizing the net annual income at an appropriate rate of interest, averaging the past sale. So we have discussed about various types of method. Even if you do not remember the exact definition, income capitalization method, capitalizing the net annual value, averaging the past sale prices of the similar land, no, that would be the sales statistics method or comparative method. All right, correct answer will be option C, capitalizing the net annual income. At least read the statements very carefully. Income capitalization method, the question is asking you. Statement C is saying capitalizing net annual income. So in this manner, you can answer those questions in which you are not sure about. With respect to the sales statistics method, which of the following statements are true? It relies on the sale value of the comparable land in the vicinity. It considers physical features like fencing and cottages. It uses years purchase factor to derive value, or it is suitable when reliable data is available. What will be the correct answer? When we are talking about the sales statistic method, what will be the correct answer in the valuation of real property? Sales statistics. The correct answer will be option A, 1, 2, and 4. Year purchase factor to derive value is not used here. In the sales statistics method, it is not used here. What is the sales statistic method? Valuation is based on the comparable sale value of similar agricultural land located in the vicinity. When we use the year purchase factor, then we are using the income capitalization method. Income capitalization. So the correct answer will be option A. If the sinking fund factor for 25 years at 5% compound interest is 0.021, what is the annual provision required to redeem 15 lakh rupees? If you remember, yesterday we had discussed about the depreciation and sinking fund. How do we calculate the sinking fund? How do we calculate the sinking fund? You simply multiply the how what will be required. The sinking fund for redeeming original capital of 15 lakh will be what? It will be 15 lakh multiplied by 0.021. 15 lakhs multiplied by 0.021. Calculated. Very simple. It is very simple. There's no complicated formula that is being used here. Simply the factor for the redemption, compound interest, multiplied by the amount that we want to redeem. So it will come out to be 3,15,000 should be kept aside as a sinking fund to recover 15 lakh rupees. All right. The original principal was 15 lakh. After 25 years, we will need 3 lakh 15,000 to recover it. 3 lakh 15,000 should be there. Not 31,000, 3 lakh 15,000. Next. Regarding the depreciation of buildings, consider the following statements. Depreciation is charged so that accumulated depreciation equals original investment. Obsolescence refers to the loss in value due to outdated design and amenities. Straight line method allocates depreciation unevenly over the asset's life. Depreciation is influenced by structural design and climatic condition. So what is depreciation? Loss in the value of an asset due to normal wear and tear or technology, obsolescence, or any other reason. Okay? So what will be the correct answer? Here you need to eliminate the incorrect statement. See, the straight line method allocation depreciates unevenly. No. The straight line method allocates depreciation evenly over the asset's life. That is the straight line method. Written down method, it is a percentage. It keeps on reducing every year. So the written down method would be uneven. Correct answer is option A, 1, 2, and 4. Right. Regarding what does the sinking fund factor represent in the property valuation? The annual depreciation rate of the structure, the present value of future rental income, the cost of rebuilding the structure at the end of life, the amount that accumulates to rupee 1 over a period of compound interest. What will be the correct answer? What does the no, we are not asking about the meaning of sinking fund. What you are telling me, the cost of rebuilding the structure at the end of life, that is related to sinking fund. You need to answer about the sinking fund factor. Sinking fund factor. So it is the amount that accumulates to rupee 1 over a period at compound interest. This is the theoretical definition of sinking fund, right? Sinking fund is the fund kept aside to recover the original principal investment, right? So remember this definition about the sinking fund factor. Which of the following best describes the written down value method of depreciation? Depreciation is charged uniformly over the life of the asset. Depreciation is charged on the residual value of the asset. Depreciation is charged on the opening value each year at a fixed percentage. Yes, the correct answer is option C. Okay. Straight down or straight value method, that gives us uniform, but written down value, it is charged on the opening value and it keeps on reducing. Okay, so written down method already done, right? Reverse mortgage. With respect to the reverse mortgage loans, which of the following statements are true? RML allows senior citizens to generate income from their self occupied property. Borrowers under the scheme must repay the loan during their lifetime. RML helps maintain ownership and residence rights of the borrower. RML is primarily designed to fund the purchase of new property. So it is yes for the senior citizen, but they do not have to repay the loan. It helps ownership and residence, and it is designed to help the senior citizen, not to help them purchase a new property. So during the life, the bank will give some payment installments to the borrower, and after the end of the term, when it becomes equal to the value of the property, bank will recover the loan by selling the house, or the legal heirs can reclaim it by paying the mortgage money. In a standard housing loan, the borrower's stake in the property. What is the difference between standard loan and the reverse mortgage we have done yesterday, right? So in the standard housing loan, the borrower's stake in the property remains constant throughout the loan tenure, decreases as EMIs are paid, is transferred to the lender after full repayment, increases as the EMIs are paid. So what will be the correct answer? In a standard loan, when the borrower has taken the loan, in the beginning their stake is low, and as the repayment progresses, they pay off the EMIs, their stake increases, and when the whole amount is paid, they will get back their property that they had given on security. All right, so the correct answer will be D. And opposite of it happens in the reverse mortgage. As the time passes by, the senior citizen's stake in the property will keep on reducing. Which of the following institutions developed the reverse mortgage loan scheme in India? RBI, National Housing Bank, Ministry of Finance, or SEBI? Which institute has developed the RML scheme in India? It is the National Housing Bank, correct. To give relief to the senior citizens. Which of the following properties is not eligible for RML? Self-occupied residential flat, residential house with clear title, commercial shop, or a residential bungalow with 25 years residual life. Which property is not eligible? So the property eligible under the reverse mortgage loan should be a residential property, and the borrowers, they should be living in it. It should be their primary place of residence. Commercial shop, not allowed. Regarding the eligibility criteria of RML, consider following statement. At least one borrower must be above 60 years of age. Residential property must be free from encumbrances. Residual life must be at least 15 years. Property must be used as the permanent primary residence. What is the correct answer? What will be the correct answer here? In the reverse mortgage, eligibility. The residual life of the property should be at least 20 years, not 15 years, 20 years. That is why the third statement is incorrect and the correct option is A, 1, 2, and 4. Rest everything is correct. All right. What is the maximum lump sum payment allowed for medical treatment subject to eligibility? 10 lakh, 15 lakh, 20 lakh, or 50% of the loan amount without any cap for medical emergency. Under the RML, medical emergency as a lump sum, what is allowed? The maximum monthly payment have been capped at 50,000. The maximum lump sum will be restricted to 50,000, but with a cap of 15 lakh rupees. Okay, that is why the correct answer will be option B. D is incorrect because it is saying without any cap. No, 50% of the amount with a cap of maximum 15 lakh. So the correct answer is B. Which of the following statements is true regarding the prepayment of RML if the borrower decides to prepay the loan? Prepayment is allowed only after 10 years. Prepayment attracts penalty of 2%. Prepayment is allowed anytime without levy. Prepayment is allowed only by the legal heirs after the borrower's death. What will be the correct answer for the prepayment? What will be the correct answer? So at any time during the loan tenure, prepayment can be done without any penalty. Prepayment is allowed at any time without any levy. No, it is allowed without any penalty. So the borrowers themselves or the legal heirs, they can also pay it. Correct. A banking professional invests 1 lakh rupees today at an annual interest of 8% compounded yearly. Using the quick rules of thumb for compounding, approximately how many years will it take for this investment to become 4 times in value? So there's a rule of 72 to check in how many years it will become 2 times, 115 for 3 times, 144 for 4 times. Divide 144 with 8%. Correct. The correct answer will be 18 years. To get the value, it will be 144 divided by the rate of interest. 18 years, it will become 4 lakh rupees. Okay. Future value factor. Now you need to use the formula. Miss Anusaya is comparing two distinct saving instruments over a 6-year term at an interest rate of 11%. Option A, installment payment of 10,000 at the end of each year. So that is ordinary annuity. Option B requires payment of 10,000 at the beginning of each year, annuity due. Given the future value factor, okay, very simple question. The question has already given you the future value factor for ordinary annuity at 11% for 6 years is 7.716. What is the future value of option B? So ordinary annuity you can calculate very easily. 10,000 rupees multiplied by 7.716. You will have the ordinary annuity. You will get the ordinary annuity. So that will become 77,160. To calculate the annuity due, we simply need to multiply the ordinary annuity with 1 plus the rate of interest. So multiply it by 1 plus 0.11. 11% is the interest, right? Right? So multiply it by 1.11. 77,160 multiplied by 1.11. Tell me the correct answer. 77,160 multiplied by 1.11. 85,000, no, 8,56,000, no, 85,647.6, right? So the correct answer will be option B. Yes. All right. Correct. Everyone. Hmm. Under Section 54 EC of the Income Tax Act, a taxpayer who has accumulated capital gains from transferring an asset wishes to claim an exemption. Which of the following conditions correctly identify the statutory rules and caps for this section? Now, when we are talking about the capital gains part, there's the whole table which is given to you. I told you about it yesterday also. 54 EC, section 54 EC, where the long term capital gain arising on transfer of any capital asset is to be reinvested in bonds issued by the NHAI or the REC, and the bond should not be redeemed before 3 years. So the correct answer, which of the following correctly identifies the statutory rules? Okay, this is a long statement. The gains can be reinvested in any public sector bank. No, it can be made in specific bonds issued by NHAI or REC within 6 months of the transfer, subject to a maximum. The correct answer should be option B, not D. The correct answer will be option B. All right. 54 EC, reinvestment has to be made in NHAI or REC. An investor sells an unlisted corporate share after holding it for exactly 18 months. According to the criteria established for short term and long term, how is the asset classified? Unlisted corporate share sold after holding for 18 months. Unlisted corporate share sold after holding for 18 months. So for unlisted corporate share, it is 24 months. Less than 24 months, short term capital gain. More than 24 months, long term capital gain. And it is held for 18 months. So it will be what? It will be a short term capital gain. For listed shares, it is 12 months. For unlisted corporate shares, it is 24 months. All right. Hmm. Mr. Raju is sanctioned a home loan of 10 lakh at an interest rate of 10% per annum. The bank releases the first installment of 2 lakh on 1st of May 2026 to fund the initial phase of construction. Due to environmental delays, the second construction stage is delayed and no further disbursements are made. So you need to calculate the pre-EMI. How do you calculate the pre-EMI? The EMI repayment starts only after the full disbursement. But here only one part has been disbursed. How much? 2 lakh has been disbursed, and 3 months is the time period. Rate of interest is 0.10 or 10%. Simple interest is calculated. Simple interest is calculated. P into R into T. P into R into T. So that would be rupees 5,001. You can calculate it on your own. Just remember, pre-EMI is P into R into T. Simple interest calculated on the actual portion of the loan disbursed in installments before the final disbursement. All right. Okay, under the SURFACI Act, we have already completed these topics. Simple registered mortgage. While comparing a simple registered mortgage with equitable mortgage, what will be correct? What is a simple registered mortgage? Without delivering possession, the borrower the borrower delivers the property, binds himself personally to pay the mortgage money, and on default they will become personally liable. That is a simple registered mortgage. Equitable mortgage, however, means where the deposit of original title deeds is done in the notified states, notified areas or towns of the state, right? In both the cases, the bank cannot sell the mortgage property without court intervention. So, what will be the correct answer? Under a simple, which of the following analytical observation is inaccurate? You need to mark the incorrect statement. So, the incorrect statement is option B. The bank can sell the mortgage asset out of the court without any judicial permission. No. Without obtaining court decree, it will not be allowed in any type of loan as per the Transfer of Property Act. All right. Okay. Then which question? Now this is from the module C. Now the remaining questions are from module C. These are very simple questions. If you want, then we can continue. We will complete the module C questions also. 15 questions are left. Only 15 questions. Otherwise, if you want, if you think the module C is simple, then you can also let it go. Tell me, what do you want to do? Do you want to continue for another 10-15 minutes? Just 15 more questions and then we'll be done with the 200 mark. So, a retail bank introduces a personalized debit card packed in a premium welcome kit. Now, that's what I was expecting. Very good. So, a retail bank introduced a personalized debit card packed in a premium welcome kit with a customized checkbook to build a strong connection with its high net worth customers. Which of the following will be the correct marketing mix? Product, process, physical evidence, or promotion? So, yes, the correct answer will be the physical evidence. Along with the credit card, the bank is making it attractive, making it attractive. So, the correct answer is C. An executive committee at a retail financial institution is reviewing its business correspondent channel strategy. According to the regulatory and industrial baseline, what are the characteristic operational constraints on a traditional rural branch? Basically, what is the advantage of a business correspondent model over a rural bank branch? Rural branch can easily serve up to 50,000 families across 100 villages within 5 kilometer radius. Traditional rural bank requires 5 years to break even. Business correspondent model can do it without creating a new branch. Yes, the correct answer will be option B. Lower cost, higher profitability. Right? So option B is correct. A customer's saving bank account is debited 10,000 due to a failed ATM transaction. The customer lodges an official complaint with the bank. Under RBI mandates, what is the maximum resolution timeline for recrediting and what penalty applies if the bank breaches? So maximum T plus 3 days, 50 rupees compensation, T plus 5, 100 rupees, T plus 7. Yes, the correct answer is B. Shadow reversal, recredit should be done within T plus 5 and delay will lead to 100 rupees per day compensation. A retail bank's website allows prospective customers to view home loan interest rate, calculate EMIs via digital tool, and submit basic online queries. However, the portal does not permit any actual balance transfers. Which type of internet banking are we talking about? You can view your loan interest, calculate EMIs, submit basic online queries. No fund based transaction, it is a simple transaction website. Simple transaction website. Under the rules governing the RBI's integrated ombudsman scheme of 2021, which of the following provisions accurately reflect the revised operational guidelines? The complainant must accurately identify the exact historical ombudsman scheme under which they are filing. No. The scheme features localized geographical jurisdiction. Again, wrong. In the integrated ombudsman scheme, the previous three schemes, ombudsman scheme for banking, ombudsman scheme for NBFCs, and ombudsman scheme for digital transaction, have been merged into one. Have been merged into one. All right. So the correct answer is C. The ground for filing the complaint, deficiency of service, non-maintainable complaints have been clearly defined. An analyst is reviewing the data streams within a commercial bank's marketing information system. The database dynamically compiles real-time end-of-day balances, aggregate deposit, loan advances. Which of the core subsystem do the internal record fall? In the MKIS, we have the internal, the market research, market intelligence, external sources. Which of these are correct? The internal records fall under which subsystem of the marketing information system? Which subsystem of the marketing information system? It falls under the internal accounting and record system. When we are talking about the marketing information system, remember there are four subsystems: internal record, sales volume, cash flow, account receivable, etc. Marketing intelligence, the various research reports, annual reports of CSO, NSSO. Marketing research will include their own field survey and interviews, questionnaires, feedback from the customer. So the correct answer is option C. It is the internal accounting or record subsystem. In a floating rate retail home loan product, when the underlying benchmark interest rate is revised upward by the lender, how does the bank typically manage the repayment schedule to mitigate immediate payment disruption? What will be done by the bank? In a floating rate, they will increase the total number of installments. Correct. The bank will leave the monthly EMI amount unchanged, increase the total number of installments. Yes, the correct answer is A. They will not increase the amount. They will not increase the amount without the consent of the borrower. They cannot do it. All right. Mr. Anand holds a standard saving bank account with a public sector bank. On 1st of May, he receives a communication alert regarding an unauthorized electronic fund transfer of 45,000 rupees from his account. The transaction was caused by a security breach in the external payment infrastructure. And there's absolutely no contributory negligence on Mr. Anand's part. If Mr. Anand detects the communication immediately, notifies the branch on 3rd of May, what is the maximum personal liability? So, no fault of the customer, and the customer also informs the bank within 2 working days. So, Mr. Anand, correct, will bear zero liability, and the bank should initiate a shadow reversal within 10 working days from the notification. Correct. Correct, right? If it would have been a third party breach and the customer made a delay in reporting the bank, then they would share the liability. But not here. Assume an alternative timeline where Mr. Anand notices the alert but delays reporting it to the branch until 6th of May, exactly 5 working day. What is his maximum statutory liability? What is the maximum statutory liability when there is a delay on part of the customer in reporting the bank? There's a delay. What will be the correct answer? It is a standard saving bank account. What will be the delay? Will it be zero liability? No, because the information should be given to the bank within a period of 3 working days, capped at maximum limit of 10,000, capped at maximum limit of 25,000, or he must bear the entire loss. So it will be capped at a maximum of 10,000 rupees. So it depends upon the type of asset to determine the customer liability. Okay, in this type of deposit account, it is 10,000. A large private sector bank realizes relies heavily on its retail asset portfolio to derive revenue growth? Okay, this question is not important. Co-lending model. A bank's internal team wants to expand its credit flow to the unserved consumer groups by entering a co-lending model arrangement with RBI registered NBFC, specializing in housing finance. According to the co-lending framework, what is the maximum direct exposure share that the bank can take on its own books for individual loans sourced by the NBFC partner? Maximum exposure that the bank can take is 80%. So the shared ratio is 80 is to 20. Maximum by the bank 80, minimum by the NBFC will be 20. Correct answer option C. Apex Alpha Bank is executing a major technical migration to upgrade its legacy. This question is also easily understandable, so we can skip it. Similar question, right? On the same case study, it is based. To gauge the financial success of its new database initiative, Apex Bank utilizes a metric that measures the total projected value derived from a customer across their entire structural life cycle, which benefit of the CRM captures. So, the customer relationship management gives various benefits to the banking organization. Here, they are using a metric to measure the total projected value across their entire structural life cycle of the organization. So, which benefit are we talking about? Structuring turnaround time via specialized vertical. Very simple. So, questions like this will be asked from the module C. And you can, if you read the statements clearly, you'll be easily able to solve it. As per the RBI guidelines, the aggregate equity investment by a bank in the factoring subsidies must not exceed. Already we have done this question previously also, right? If the bank wants to undertake factoring business through a subsidiary, then the maximum contribution investment cannot be more than 10% of the paid up capital and reserves. Evaluate the following statements about the exposure classification in factoring. In with recourse factoring, exposure is booked on the assigner. This also we have already discussed. This statement is true. Without recourse factoring, it is booked on the debtor. Again true. In international factoring, it is booked on the import factor. In limited recourse factoring, exposure is always booked on the assigner. No. In the limited recourse factoring, the exposure is shared between the assigner and the debtor. So the correct answer will be option A, 1, 2, and 3. And last question. What is the minimum and the maximum investment for individuals in the sovereign gold bonds per fiscal year? Individuals, maximum and minimum allowed for individuals: 1 gram minimum, 2 kg maximum; 5 gram minimum, 10 kg maximum; 1 gram minimum, 4 kg maximum; or 10 grams minimum and 5 kg maximum. So what will be the correct answer? The correct answer will be option C, correct. And that is all. Before you leave, I want to show you how you can download the PDF for yesterday's session as well as today's session. All right. So simply all you need to do is open your Oliveboard app. This is the Oliveboard app. I have opened it right here. Then under the batches, you will see the Super Elite plan. Super Elite plan is there. Click on the Super Elite plan. Okay. In this, you will see various batches. Scroll down here. You can scroll down here. Many options are being seen, right? Under all, I have seen here, I have reached to the all option. As you can see, this is the all option. All. Okay. Scroll down. In the end, there's the RBWM summary PDF. RBWM summary PDF is there. Once the class is over, once I wind up the session, I will also upload today's PDF. But do not worry about today's PDF. Don't go through the questions because you have already answered it. And if you think that you need to still revise any topic, download the summary PDF from the Oliveboard app. Okay? It is for your quick revision and all your doubts will be cleared if you still have any. All right? So that is all from my side. And we have completed the theory, we have completed the questions. Now, have full faith on your preparation. Go to sleep, take a proper rest, wake up in the morning with a fresh mind, go through the summary PDF, just have a quick look, right? And that is enough. Trust me, you have prepared so well that you will qualify the exam. Be confident, do not lose any hope, do not get confused there, and remember the easy tricks. Okay? Do not get stuck, do not waste your time on lengthy questions, on lengthy case studies. Mark them for review. View all the 100 questions. First attempt those that you are sure about. RBWM paper is not tough. It is definitely not tough. It is very scoring. You can score 70 plus, 80 plus. So do not worry and have faith. I wish you all the very best. These are the Telegram channels that you can join. And after your exam, all those have your shift, all those who have your exam in the first shift, do share your scores and the topics that have been asked. Okay? Trust your preparation, trust yourself, be confident, and you will qualify the exam. All right? So, all the very best, everyone. And I will see you after your exam in the exam analysis. So, thank you so much. Good night. Take care. And I'm still available on the Telegram and the community option on the Oliveboard app. Good night, everyone, and all the best.